Good morning. I am Kevin Morgan, the Executive Director of the DC Tech and Venture Coalition. I'm also the person that sent you probably 100 emails in the last 3 days, so thank you. For those of you who didn't put it in spam, and there's a couple of you I know did put it in spam, so I'm watching you. So today, thanks to Department of Insurance, Securities, and Banking, the Office of Innovation, Tamara, welcome Commissioner Woods of Department of Insurance, Securities, and Banking. We have a great run of show, a wonderful day. Today's we're setting the theme for DC as an epicenter for fintech regulation. There's a lot of momentum. We're moving quickly. There's a lot happening here, obviously on Capitol Hill, but also locally. And this is what we're looking to highlight, is that connection between federal and global, with DC, the local environment, as the anchor of that. We're here. I do want to call out and note that, one, appreciate everybody making it first thing in the morning after a holiday. Hey, Dante. As well as the World Bank annual meetings. I'm getting some texts that there have been some difficulties making their way in. So thanks for you that have navigated that. The room, this audience, just to level set for everybody, 70% of you are C-suite executives and founders. So this is a room of peers. 5% of you are active investors, some direct managers, specifically CTOs, CISOs, people with a technical background. Policies, regulators, 6%, and there are a handful of service providers who are constrained to the tables. I'm just kidding. Wonderful people. What we really try to do with these rooms is make it about the peers and the executives. So I've asked all the panelists and speakers to really focus directly on technical expertise and knowledge. The least common denominator in this room is a CTO, so strap in. We are going to go quickly. There's no active Q&A on these panels. At registration, we asked a lot of questions and got some background information. So all the panelists have received a 4-page pre-brief that we went through with targeted questions based on what you've asked. So if you do have questions, on either side of me are QR codes. Those are live. You can submit your questions. And then if we don't get to those during the panel, we will follow up with those afterwards on social media. So with that, again, we're going to go. Try and stick as much as possible to the time schedule. We're excited. I do want to thank a few other people, Josh Aswee, Amber Dudley, who else? Marissa Jennings, Ashton Brown, Michelle, where are you? Urban, who's a board member, Ashton Moore, another board member, everybody, Golden Triangle, Elizabeth Packer, who is really an advocate for this neighborhood in the Penn West Equity and Innovation District, Department of Employment and Department of Employment Services, who have launched a regional capital hiring initiative, especially to help those displaced by federal downsizing. I believe I've hit everybody. If I haven't, somebody will pull me aside and let me know, and I'll mention that at another. So here's what's going to happen. The panelists will go ahead and line up. Dante, you're good. We'll line up here. We'll move people on stage. When there's about 30 seconds left, I'll come back on. We'll move the panelists out. If you have Q&A or questions, if you do have questions, please go on the other side of the curtain, a little bit farther back from the door. We'll have somebody pushing back because there is a noise issue here. And with that, I will welcome Karima Woods, Commissioner for the Department of Insurance and Securities and Banking, to kick us off, and welcome.
Thank you, Kevin. What I know about Kevin, and I've had the good fortune of working with him for many years now, he moves quickly. So I'm going to move quickly right along with him. Good morning, everyone. Good morning. Now, when I walked in the room, I could feel the energy. It was electric. You all were buzzing and networking and chatting it. So we're going to try that one more time. Good morning, everyone. Excellent, excellent. I know I am truly in the right place at the right time. I want to welcome you all to the second annual Fintech Summit here in the District of Columbia. And for those who have traveled from near or far, I want to welcome you to the nation's capital, a place where regulation, innovation, and acceleration meet. As Kevin has shared, I am Karima Woods, and I have the honor of serving as Mayor Bowser's Commissioner for the DC Department of Insurance, Securities, and Banking. If you're not familiar with what we call DISB. We are the district's financial regulator. We are responsible for regulating the financial service firms that impact the lives of our residents here in the district. Part of our mission is also focused on financial education and inclusion. We're also very much committed to access to capital. And a new area, which I'll talk a little bit more about in my remarks, we also focus on innovation and the role that innovation plays within the financial services industry. So I'm pleased to be here along with a number of our partners, many of which Kevin has already mentioned. And I'll just highlight particularly my team. If you're in the room, if you could just stand so the folks know where you are and who you are. This is the DISB team that is here, and I just want to acknowledge them and thank them. Special thanks to Tamara Ziden, who is the director of our Office of Innovation and works closely with not only Kevin, but with many of the fintechs here in the district. We also work closely with our Deputy Mayor Office for Planning and Economic Development. If the folks from DIMPED aren't here, they will be here before the end of the summit, and they're very important partners to us as well. And also the DC Economic Partnership under the leadership of Derek Ford. I want to also acknowledge and thank District Angels and, of course, the DC Venture Tech Coalition. So with that, today's gathering is not your ordinary gathering. This is truly an opportunity to have a front row seat of the future of financial innovation here in the district. Many of you know that here in the district, we're at the crossroads of regulation, global finance, and policy debates. Lots of policy debates. Debates around AI, digital assets, open banking, consumer trust, all of which is shaping the next generation of fintech. So whether you are a policymaker, investor, regulator, or innovator, you're not just observing fintech here in the district, you truly are helping to define it. One of the things I like to do when I'm in front of audiences like this is really brag a little bit about DC. You hear a lot about the district, but as someone who has had an honor to live here, raise a family here, work here, have a home here, go to school here, it is a place that I call home. And it is also a very special place because we have a unique market like none other. Not only is this the nation's capital, but it also is a place where you will find universities, colleges with top-tier talent, not just in the district, but in the entire region. We also are in close proximity to a lot of decision makers. And I'll also add, and too often, I don't know if people are aware of this, but our mayor has made a number of strategic investments in growing the district's economy, particularly in key areas like the innovation economy. It's a part of her growth agenda, and she's been committed to areas like fintech, which she wants to make sure that we are working to attract more fintechs to the District of Columbia. So it's an honor to be here under the leadership of our mayor. We're fully committed to fostering inclusive economic growth through innovation. At our office, as I mentioned, we have a new office, the Office of Innovation, which we launched a couple of years ago. And we are working to also position the district as a hub for responsible fintech development. And we're doing that in tandem with a number of other key district agencies and also key district stakeholders as well. So we all know that the stakes are high, from embedded finance to decentralized systems, from Capitol Hill legislation to consumer trust. This is where the rules are written and the risks are truly being weighed. So that's why we're here today. I'm proud to be able to join you, not just as a regulator, but also as a partner. I do encourage you, if you haven't done so, to visit our table, our Office of Innovation table. We want to be here to support you, ask any questions. We also have virtual office hours or in-person office hours if you want to meet directly with any of our staff members. And before I close, I just want to share this one fact with you. According to KPMG and their most recent FinTech report, in the first half of 2025 alone, fintech companies secured $44.7 billion across 2,200 deals globally. Now, that number is down from the previous quarter, but it is quite significant. That's not just capital, it truly is momentum. And DC is at the center of it all. So thank you. I want to just say thanks to all of our speakers and panelists. I've had a chance to review the list. Very impressive lineup. I know today will be quite dynamic, as we are also heading into FinTech Week. So I'm sure many of you know that we also have DC Fintech Week, and so we'll be seeing you at a lot of the meetings and the engagements that the FinTech folks have planned for this week as well. So glad to be able to join you. Thank you for being on this journey with us, and very much looking forward to the conversation today. Thank you, Kevin.
All right. Well, the commissioner is technically my boss, actually. And I'm going to talk to you about a couple of topics. It's great to see a lot of friendly faces in the room this morning, and great to be here. If I told you this were my first event of the day, you would say, well, that's an early start. It actually began in the UAE at 5:30 in the morning, and then there was another session. But when the capital of the United States of America calls, you take the call and you answer and you take the podium. But why is the commissioner my boss? So all of these years ago, I began my career in finance and banking in the insurance market. Once upon a time as a broker and an agent, when they had me very close to the printer and the copying room and living on commission checks. And then one day I ended up running that company called Clemens Worldwide, which was domiciled and regulated here in Washington, D.C. And as I watched this firm continue to grow and evolve, I said to myself in my very first career Jerry Maguire moment, I think we could do better. And so I went off and grabbed the goldfish and grabbed a friend, and we started an insurance company called Risk Cooperative. And the worst career advice I ever got was from lawyers and accountants who said, do not domicile your business in Washington, D.C. I ignored them. And till today, the red thread that defines my career, and frankly, the red thread that defines what I do as a business and what we do as a company, and frankly, the economic competitiveness of our country will be defined in this city. So it is genuinely a great honor to hear the commissioner's words and a great honor to see this first gathering of what will be an exceptional week. A week when all of the world's finance ministers, central bank governors, policymakers from literally the world over are here in Washington at the IMF World Bank Spring meetings. Obviously, Chris Brummer's DC Fintech Week, an event that is larger than life and punches above its weight class, just like Washington, D.C. does, is alive and well as well. But the worst career advice I ever got was do not start your business in Washington, D.C. And so for the search of a little bit of regulatory arbitrage or tax arbitrage, the advice was go elsewhere. But then when you think about it, that was also not a narrative that was alone to tax accountants and lawyers more than a decade ago when I started my little business. It was also advice that was being conveyed and portrayed, and often perhaps a little too stereotypical, in speeches in Silicon Valley. A few years ago at the All-In Summit, Bill Gurley, a famous investor, a famous entrepreneur, said a feature of why Silicon Valley is so successful is its distance from Washington. That's the narrative, 3,851 miles away from DC, and all of a sudden, you now understand why Silicon Valley can create value the way it does. But then some years later, as I was running my insurance business, a plucky little startup insuring the uninsurable, competing at literally the world stage, not looking over my shoulder once, Risk Cooperative, I'm pleased to say, is still a going concern today. And domiciled in Washington, and from Washington, literally insuring risks all over the world. But till today, actually, in my view, the distance from Washington is a bug, not a feature. And the best proof I have of that is a few years ago, 7 years ago now, I was tapped by a small fintech company or a fintech aspiration known as the Libra Project. You may recall this. This was Facebook's attempt at uploading the US dollar onto the internet, and all we had back then was a mere little white paper, 28 member companies, the combined GDP of nations and several billion people as a captive addressable market. And I tell you, the totality of the success or failure of that project hinged on Washington, D.C. And the distance from Washington was the critical flaw in its thinking and the critical flaw in its architecture. And so I told them as much as I spent the next 90 days as they were trying to recruit me saying no. Why would I join an effort? Have you seen what I have written about big tech? Do you know who I am? Did you Google me before you tried to recruit me? I have a nice little shop and I like independence. But sure enough, I realized also that when given the chance to take a seat on a rocket ship, you take whatever seat you can get. And I had been writing about the emergence of digital assets in fintech for years. In Forbes, I used to write 7 articles a month for sport. And then I said to myself, I could either chronicle the emergence of this innovation or I could be a protagonist. And so for the young, budding, aspiring entrepreneur in the room, if ever you're given the choice, be a protagonist. And if ever you're given the choice or some really bad career advice about where to do it, try to do it in Washington, D.C. And I'll explain why. So the Libra project, we literally had a white paper 7 years ago. And we did the right thing. Oftentimes, the criticism that regulators give and policymakers give of fintechs is we don't ask for permission, we ask for forgiveness. In this instance, we asked for both. So much so that Mark Zuckerberg was brought to Washington for hearings, and if you find any of those old pictures, you'll see me to his left, right on screen on C-SPAN, not smiling, not making a gesture, not doing a single thing. But the entirety of that project's future hinged on what happened in this city. And in that case, just like many others since, the distance from Washington, the disconnect from Washington, and the inability of showing up as a big tech or a small tech or any other company in any other domain and being tone deaf to what the city represents for competitive advantage, for the innovation agenda in our country, and frankly, the world, was a critical flaw. And so we spent the next 7 years trying to reconcile that critical flaw. And so then I realized a lot of key things in that, sitting in the hot seat as the cut man for the witness, Mark Zuckerberg and many others in between, I learned a lot that it also informed how the work we do at Circle would not try to skirt around the rules, but draw within them. And so Libra, we now know, came and went. Its obituary has been written 1,000 times. And if given the chance to do it all over again, you see I'm getting emotional. If I were given the chance to do it all over again, of course I would have done it. You know why? Because I had to tell people who criticized me on WhatsApp, I couldn't believe, Dante, you joined the heart of darkness. I'm like, you're using Facebook properties to tell me that I joined the heart of darkness. And I had to remind them that I care about financial inclusion more than you hate Facebook. And if for nothing else, win, lose, or draw, a project of that scale showing up in Washington, galvanizing the attention of the world, of our policymakers and our regulators, would, if nothing else, force a conversation on boundaries, future of money and payments, who should have access to the payment system. Is it really your money if you have to ask someone to spend it and you have to pay someone to hold it for you? And so there are flaws in the banking system, and there's flaws with money, but that doesn't mean that the emergence of alternative payments and digital assets and crypto and stablecoins has to come at the expense of the rules-based system. If anything, in part because we've built this in Washington, and from Washington we've broadcast this to the world, I actually think we're completing unfinished work in the banking system and the global economy. Your and my financial needs don't take bank holidays, but unevolved, the financial system does. And that's where I think the next chapter begins, right? So 7 years later, you put out a white paper with the byline, reinventing money, and Facebook is one of its parents. It is your fast track to being in every public hearing, everywhere in the world, all at once. And yours truly had the displeasure, and frankly, the pleasure of sitting in those hot seats and trying to evolve to where we are today. So where are we now? Kevin gave me this extraordinarily complex charge. He's like, Dante, I want you to talk about crypto, stablecoins, the Genius Act, crypto market structure, agentic commerce, cloud infrastructure, what's happening globally, what's happening domestically. I have 11 minutes and 51 seconds left, so let me try to do exactly that. Otherwise, I won't be invited back. So what has happened since, and why is Washington the epicenter of not just the future of technology competition in the world, but frankly, the future of fintech as well? For the last 7 years, Congress, in a very deeply bipartisan basis, from the chairmanship or chairwomanship of Maxine Waters to handing over the gavel to Patrick McHenry to fundamentally where we are today, has done the unthinkable. We've passed a new law in the United States known as the Genius Act. The Genius Act reconciles what was historically a fintech constitutional crisis in our country, which is that we're the only advanced economy in the world that regulates payments and banking at the state level, and no state wants to give up those rights through federal preemption to federal stakeholders. But why is it important that we have a federal law? And what is critical about this law vis-a-vis the agenda of innovation and competition at the state level, including in Washington, D.C.? The United States is the only advanced economy that doesn't regulate payments at the national level. If you go to Singapore, if you go to the UK, if you go to Europe, if you go anywhere in the world, you have a whole of government, whole of economy approach for fintech innovation and banking and non-banks competing in payments. The US was an outlier. In fact, one of the only reasons we set up the Libra Association in Switzerland wasn't because of regulatory arbitrage. The Swiss regulate systemic banks and all kinds of institutions. It was because the Swiss had a regime for bank and non-bank activity at, again, the whole of economy level. There were no shortcuts in a project that big. We were systemic at birth. And so now we have this new law. What does that law do? It acknowledges the critical feature in our country of fintech federalism, which is, like our commissioner here in Washington, insurance and payments are regulated at the state level. So a company like Circle, we have always had those licenses. We were licensed like PayPal, but yet in the public domain, when you upload the US dollar onto the internet, there's a totally different set of expectations. And there's a totally different set of reach and scale. This is a dollar at the scale of the internet. And so in that level of competition, you do need the imprimatur of the state, and we needed the imprimatur of a new law. And there was no world in which you could get that done unless you were in Washington, D.C. When I joined Circle, we had just about 100 people 4.5 years ago. And in that same time horizon, hopefully the rest is somewhat historical, we have processed more than $30 trillion of payments in more than 190 countries, and any basic internet-connected device anywhere in the world is a part of that new financial infrastructure. That means that if you're excluded, it's because of other systemic reasons, it's not the technology. It means that the role of the dollar is preserved. This is a national competitiveness issue, not just between companies, but actually at the nation state level. Currency competition is a huge theme for this week at the IMF World Bank meetings. And a lot of companies and countries describe this as a digital currency space race. And I'm actually totally technology agnostic as to how we win and how we compete in the digital currency space race, but none of us in this room would like the United States losing it. And so that's where this Genius Act was such a game changer. So what does the Genius Act do? It allows for state-based oversight and state-based issuance of stablecoins at $10 billion and up, just mirroring the dual banking system. You have to get a federal charter. That charter would point you to the OCC, the Office of the Comptroller of the Currency, and from there, you can compete at scale. So that's great because it protects and addresses this fintech federalism that is a feature of our country, but it also gives us at long last a regime at the whole of government, whole of economy level to innovate in this domain. So stablecoins are here to stay, and if a stablecoin were unregulated, it's because the issuer chose to be unregulated. It's no longer a case for a void of the regulatory regime. That's really important because for a very long time, to quote Jerry Maguire, the whole category suffered from the show me the money test. In fact, here in Washington, I hate to say it because I love the city, built a business here, built a second business here, kids in school, skin in the game, the whole thing. But our city is also home to a monument to financial alchemy and a monument to what can happen when unchecked fintech can get access to our economy and to our country and to our markets. The stadium of our local baseball team still carries the name Terra Luna on it. Terra Luna, for those of you who are a little unfamiliar, was a so-called algorithmic stablecoin that blew up in the span of a weekend. And one of the things I hate most about unchecked fintech is the people who suffer the most when these things blow up look like us, look like me, are in our city. And so there's also, sadly, Washington also played home to a lot of regulatory overreach and this rulemaking through enforcement dynamic that not only, I think, has created new boundaries for the sector, but has really changed politics at the federal agency level as well. Regulating after the fact, after a crash, is like an airline pilot putting on the safety belt as the plane is crashing. And so I think there too, DC was also playing home to not just new rulemaking and new laws, but candidly, better forms of market conduct. And that's on us, the entrepreneurs and the innovators and the developers and beyond. So now, when we look across the world, this was the world tour part of Kevin's mandate to me. What is happening, right? In Europe, up until very recently, Europe had more legal and regulatory clarity for US dollars than the United States did. Shame on us. The Genius Act contrary to popular belief, was a massive bipartisan success. 108 Democrats locked arms with their Republican colleagues and voted in favor of it. But across the Atlantic, the Europeans had this broad set of rules known as the Markets and Crypto Assets Framework that set a floor for market conduct across the EU. The EU itself is suffering from a competitiveness gap. Mario Draghi, former former head of the European Central Bank, said it the best, which is, there's a mandate to get the European economy going, both for the domestic competitors and international ones as well. We're regulated in Europe out of France, but the European regime rather creates legal certainty for this industry and beyond, and for fintech and beyond. And there too, you could see a massive competitive dynamics developing that are in our interest. In fact, so much of Genius, 80% of Genius, I would argue, is built on the structure of the European framework. The 20% that is different, in my view, is actually better, more conservative, more sort of restrictive vis-a-vis prudential risk and how these things evolve at scale. And then elsewhere around the planet, you see, I think, an important set of areas of convergence between digital assets and fintech, AI, and a whole host of novel technologies. And so therein maybe lies a couple of areas of just maybe interesting commentary. You need open, programmable, composable money uploaded onto the internet to also unlock the next set of innovations that are coming from these domains. And if you think of blockchain as an isolated domain and crypto as an isolated domain and totally distinct from AI, I think it would be a huge mistake. If anything, there's convergence happening between these two domains. Agentic commerce, agents that are active, that can do the work for you, and that are also empowered with digital money. Stablecoins are the perfect digital thrift for that activity as well. And so you see this massive convergence taking place in that domain too. Now, should all of this end up taking place and not actually advancing objectives that are in the public policy domain, objectives that are in the sort of entrepreneurial domain, we are wanting for competition in fintech and payments. That's why I think these DC Fintech Weeks and the event we're hosting today are so important. Ignoring policy as the sort of basis for competitive advantage is oftentimes effectively reconciling or resigning your business to potential irrelevance or way too much risk. For example, any fintech operator that ignored the pre-existence of financial crime compliance laws oftentimes built a critical flaw into their business model. Any fintech that ignored the critical nature of trust, transparency, and accountability, the things that have been massive difference makers for us at Circle, way before we were asked by any regulator to provide transparency on reserves or accountability on combating financial crime and illicit finance, would have been a critical mistake. But today, the good news is a lot of these things are features of our innovations and not bugs. And so maybe a couple last quick closing comments. Distance from DC, not an asset. And I think anybody promoting that as a concept is making a massive mistake. DC itself is not an economy in which you just show up because you want to address policymakers and regulators. It's actually an economy and a market in which you could build. We have an exceptional talent base in our city. We have exceptional world-class education in our city. It stands to reason when Amazon was looking for the domain of its HQ2, it chose the greater metropolitan Washington area. And despite, again, some of the politics and despite, again, some of the national issues that oftentimes play out in Washington at the expense of Washington, the city itself is the home to build businesses. And the worst career advice I ever got, and there's a couple lawyers and a couple of tax accountants that no longer work with us as a result, was to not start something in Washington. Years later, I ended up becoming the president and then chairman of the Harvard Business School Alumni Association here in the city too long ago. And it was like Hotel California. I could check out, but they would never let me leave. And then I realized what had happened there with that succession plan wasn't just giving me the mantle of leadership, it was that no one else wanted the job. But I think the most impactful thing we did then was to reinvigorate the venture capital and the angel investing side of the equation. Because a lot of pent-up entrepreneurship needs capital. And so it is important that the city also has an innovation agenda to accompany and to unlock that pent-up interest that we see in the city, because it's very easy to skew large and it's very easy to skew lawyered and lobbied. But we also have to remember that a big part of the innovation economy is actually startups. And frankly, one of the things I love most about what we're doing at Circle and what we're doing with the blockchain fintech ecosystem is that for the first time in human history, we have a technology stack that enables anyone, anywhere to be a builder. It's not enough to just lower the cost of payments. Based on stablecoins, blockchains, and open infrastructure, you don't have to be a technologist in Silicon Valley, where the lion's share of the GDP value has gone over the last many decades of the internet wave. You actually could be anywhere. And I think being here as builders and early stage companies is an extraordinarily important opportunity where the tech is no longer an obstacle. The tech is actually very readily at hand. So with that, 35 seconds to spare. Kevin's going to cue up the music and get me off the stage. Grateful to the commissioner, grateful to Kevin and the organizers, and grateful to all of you for your attention this morning. Thank you.
Thanks everyone being here this week for FinTech Week. And Dante's a tough act to follow, but we'll try our best. So my name's Chris Hayes. I'm a partner at Thorn Run Partners. We're a bipartisan government relations firm based in DC, and I lead our digital assets work. And I wanted to briefly have my panelists introduce themselves.
Thank you for having us here. My name is Grant McCarty. I run the Bitcoin Policy Institute. We are the largest cryptocurrency think tank in the country. What that means is we've assembled a cohort of a few dozen academic fellows, PhDs in environmental science, philosophy, economics, and they're all studying the intersection of what they got their PhD in and Bitcoin. Our mission with the Bitcoin Policy Institute is really to help America navigate the rise of Bitcoin. This technology didn't exist 20 years ago, and now today, Bitcoin is the 5th largest asset in the world. It is a $2 trillion asset. And so I envision a world where America and Bitcoin thrive and flourish together, but it is very important that those two things are symbiotic and are not working at odds.
Thanks, Chris. And a big thanks to Kevin for the invite to be here. My mom was born and raised in Washington, D.C. I've been here for 20 years, so it's really exciting to be part of this community. So really excited to be here today. As was said in the introduction, I'm Ruben Smith-Vaughn. I'm the head of policy for the Americas at Ledger. For those of you that don't know Ledger, we are the largest digital asset security company in the world. If you haven't seen them, these are our cool little devices that we make. They allow you to self-custody your private keys when you're trading on digital assets. We've sold over 7 million of these devices since our founding a little over 10 years ago, and about 20% of the world's crypto is currently, through their private keys, being leveraged on our private mechanisms that we've created, like Stacks and Flex and Nano, and none of these devices have ever been hacked. So for us, this is something that's really important, this ability to provide a security opportunity for individuals to leverage the blockchain and digital assets, but really to self-custody all of those assets, which is something that Dante talked about previously, that ability to be your own owner of your digital assets.
Great. Well, I think we'll jump in and we'll sort of dive into the questions around what's happening legislatively. I'm sure many of you out in the media have been learning a lot about this. We had a stablecoin bill, the Genius Act, passed into law earlier this year, which was a major effort that passed in a bipartisan fashion. And it has some potential lessons for us as we think about broader crypto market structure. So right now there's 2 bills. There's the Clarity Act, which is a House version by both the Agriculture Committee, which covers commodities, and the House Financial Services Committee, which covers securities, which has passed the House in a bipartisan way, and it's sitting at the Senate. And in the Senate, as the Senate does, they're doing their own thing and not doing anything with the House bill. And so why don't we talk a little bit about that? How do you guys think about sort of the path for crypto market structure, whether it's Clarity, whether it's the Senate discussion draft? What are the hurdles? What do you guys think?
So when we think about market structure bill, basically what we're talking about is establishing rules of the road for the entire cryptocurrency industry. And the bill that passed in the House is this behemoth of a bill, hundreds of pages, and it's been debated for years and years. When I think about where we're at and the political viability of creating market structure for cryptocurrency, sometimes I think a lot of people believe that these are new discussions that we're having, like the conversations that we're having just because we're dealing with cryptocurrency, that they're novel and it must be innovative. And in reality, I think they're conversations that we have been having every time we talk about new innovative technology. So let's rewind 30 years ago and think about in Washington, the advent of the internet, how were we thinking about regulating really this early stage protocol that we didn't even know what it would be yet. And 30 years ago, we had a decision to make. Do we want to support an internet that is open, that provides fair, equal access to a number of different players, and maybe it's a little bit messy? Or do we want to support an internet that really favors incumbents and has higher compliance costs, maybe is a little bit safer in some terms, but we lose out on some of that innovative edge? 30 years ago, we chose an open internet. And ultimately look at the rewards and everything that we've reaped from that decision. Silicon Valley today would not exist without decisions we made 30 years ago from a regulatory perspective. And America would not be the 21st century global superpower from a capital and financial perspective if we had not made these decisions. So all this is to say is we are making the exact same choices today when it comes to the Clarity Act, and we are deciding right now, do we want an open system where builders and developers can innovate and try new things, or do we want a closed system that favors incumbents and a few players who can afford millions of dollars of compliance costs? So right now, the political path to clarity is actually coming down to one or two of these key choices around open source development and decentralized finance, and basically allowing small players to build and innovate using Bitcoin, using different cryptos, and just building tools. And it seems like that's a political sticking point right now, because some people would rather see us basically create banks 2.0.
Ruben.
Yeah, so maybe I think one of the big things we need to think about, and a lot of us live in Washington, D.C., so we get to live in the heart of the beast, if you will, right? If we're having this panel in like Idaho or in Nebraska or in even California, you'd be having a very different conversation. But most of you are plugged in because we're forced to be plugged in. It surrounds us every single day. You know, half of our spouses are stuck at home right now because they can't even work. I think the big shift that we've had over the last 5 years is that we were originally talking about if this is a space that should be regulated. And I think that conversation's gone, right? We're now at a place today where there's now agreement across the political spectrum about the if is gone. The question is now, how do we do that, right? And we saw through the Genius Act, and Dante talked about that first piece of legislation that was passed, bipartisan passage in both the House and the Senate, and is now a law today that sets really the global mandate of how we should be using stablecoins, and I think sends a really powerful message globally about what that should look like and how other governments should think about it, and really helps put the United States at the forefront of the conversation. So I think now that we've gotten past the Genius Act, we've established that there is bipartisan agreement about the need to do regulation. We were able to do that effectively in the House, right, through the Clarity Act, which importantly got bipartisan support. I think it had something 60 plus members of the Democratic Party joining Republicans to pass that legislation. I think
it was 78.
78, thank you, perfect. Even more, I always underestimate, it's better that way. And I think what that sends as a message is that there is this bipartisan agreement after years of discussing the issue, right? This bill didn't come out of nowhere. It spent 5 years really being developed across the political spectrum in the House to ensure there was agreement. And so now we're in the Senate, and I think both the government shutdown, which is creating more political strife in our country, unfortunately, and really creating more divisions, is going to slow down the process for that bill to move forward. I think there's a lower probability now that we'll see the bill pass this year. There was also recent movement by a number of the Senate Democrats who are helping through that negotiation. They put forward their position that also will likely slow down the process even more. And so I think the likelihood that the bill passes this year is unfortunately much lower than it was, say, 6 weeks ago. I think we're still really, really hopeful, and a lot of us that are in this room will hopefully do a lot more advocacy to explain to both Senate Republicans and Democrats the importance of passing this bill as soon as possible. Unfortunately, the longer we wait, as you all know, the political cycles in this country, once we enter next year, it'll become even more challenging to get approved. And I think the longer we wait, we're ceding that ground to other countries to make decisions. And Dante talked about the European style of regulation before coming to Ledger. I worked at Amazon, and so all things EU regulation, whether it's the AI Act or GDPR or the OTT directive, these are things that have really stagnated innovation in EU, and they're unfortunately exporting those policies around the world. And I think one of our big concerns is if market structure isn't passed in the United States, do countries around the world adopt MiCA, which is the regulation that the EU has put in place? And I think what that would really do for this global industry, because this isn't just the US industry, it's global, is unfortunately really negative.
Just want to mention a little bit about market structure for maybe folks who are less familiar. The reason why this is so important is because the base layer infrastructure, what allows public blockchains to run, is really determined about whether those tokens that process the transactions are securities or commodities, right? And that's been the fundamental issue that crypto market structure is about addressing. So you can't have payment applications with stable coins. You can't have putting capital markets, tokenizing traditional financial instruments without being able to run those on public blockchains. And in order to have regulatory certainty, you need market structure to have certainty for those systems to ultimately be built. That's why this is such a critical bill, and it's actually much more complex, I would say, than stablecoins were. One of the main components, as we saw under the last administration, is really whether these tokens are unregistered securities or not, right? That has been the fundamental argument under former Chairman Gary Gensler. There are many enforcement actions against exchanges like Coinbase and Kraken, et cetera, that were basically accused of being unregistered securities exchange because they facilitated trading in these specific tokens. But then there were also the layer one blockchains themselves, whether those were issuing unregistered securities. And so market structure is really about clarifying whether those are actually securities and have a way for them to come in to compliance to adjust for the technological elements of them, or whether they're commodities and governed by the CFTC as opposed to the SEC. And so the bills in Congress, as we know, the Clarity Act, the RFIA, which is the Senate version, it's a little less exciting nomenclature. When you think about the House bill, it came out of Agriculture and Securities under the Financial Services Committee as one piece, so you knew what were commodities and what were securities. In the Senate, the Agriculture Committee has actually not released their bill, so we only have half the bill in the Senate version, so the banking bill. And so as you guys think about that, particularly with the CFTC only having one chair who may not be there much longer, and the SEC a bit more staffed up, how do you see that turf battle playing out between the SEC, CFTC, both in the legislation and in terms of, is the SEC, because it's more well-staffed, do they have more ability to take control of the process here?
I think in the immediate term, there's going to be very little enforcement, regardless of what happens here. Perhaps an annoying answer. The winner isn't the SEC or CFTC. The winner is Bitcoin. It is the only cryptocurrency that's had any sort of regulatory certainty with or without market structure. It is a commodity. It's always been a commodity. It's called digital gold for a reason, right? There's no CEO of gold. There's no owner or company that owns all the gold in the world, just like there's no CEO of Bitcoin. It is a decentralized network that millions of people around the world use. And there's a reason why this thing is disrupting and reshaping global finance and actually helping change global financial order. A lot of other cryptocurrencies, I would say, are more analogous to like really interesting startups. And that type of innovation, incredibly, incredibly important. And market structure is seeking to like provide clarity here. No, actually pun intended. But Bitcoin is in a class of its own. And if there's one thing you take away from this conversation, I would hope that there's Bitcoin and there's everything else. And ultimately, they can complement each other. And America can win if we support both of these. But recognize Bitcoin doesn't need the market structure bill. That's one of the beauties of the innovation.
Yeah, I mean, I think framing it as a turf war is unfortunately not beneficial, I think, to the average everyday individual in the United States, right? I think what we need to think about is how do we help them collaborate more effectively? And I think they're starting to do that. You're actually seeing some collaboration between the two. I think ensuring that there is a division between what the SEC has been doing historically and shifting that mental model for how they're approaching blockchain and crypto and digital assets, I think is really important, and empowering the CFTC to do what they do best, which is regulate commodities, and ensuring that they're empowered to do so is important in creating that division. I think is to the best benefit of both consumers here in the United States, but also entrepreneurs who are trying to figure out. I think that lack of clarity, also pun intended, is what's really impacting the industry in a really negative way and forcing companies to operate offshore and in other places. And so if we can get that clarity and help create that division so they can effectively focus on what they do best, would help drive a lot more funding and innovation here in the United States.
Well, you heard it here, guys. Buy Bitcoin. That's what I learned from this panel. So, speaking as we talk a little bit about the SEC and the agencies, Chair Atkins at the SEC has been really focused on working with industry. I would say with his Project Crypto, this potential innovation exemption. I'm not even sure what will be in that. Lots of great ideas if people want to stick something into that. How do you guys see sort of industry and government, particularly? We're sort of seeing this collaboration at the SEC. How do you guys think about that, and where should they be collaborating?
Yeah, so much of this is just base level education. It might feel trite at certain points, but for years and years, we mentioned some of these Wells notices, these really enforcement actions that were being taken upon different actors in the industry, and there was no two-way conversation. It was one way being handed a piece of paper, and so there wasn't really an effort to understand how the technology worked, who was using it, how decentralized were these different networks. And I do think recently that is kind of the key step forward that's been taken, is it's more of a two-way conversation. I'll plug something that we've been doing and that I know other people are doing as well, but we have a congressional fellowship program where we're able to actually staff crypto experts within congressional offices, just give them a free staffer who's a pure play expert on Bitcoin and crypto technology. And that type of acceptance from both Democrats and Republicans within the past year has been a complete phase shift compared to where we were 2, 3, 4 years ago.
Yeah, I mean, I think you mentioned this idea of like regulating via enforcement, right? And I think that stopping is incredibly important for the industry because it allows the industry to, one, continue to innovate, but two, have an understanding of what the actual rules are. And that's why clarity is so important. I think, you mentioned education. I think that's the most important thing. We have the benefit of living in Washington, D.C., so we can go to Capitol Hill anytime we want. And I think there's a huge lack of understanding. Dante talked about the hearing that he got to sit behind Zuckerberg. And if you watch that hearing and tried to hear members of Congress try explaining what Facebook was to the founder of Facebook, it was so cringy to have to listen to. Like, it's actually fun to watch because they have no idea what they're talking about. And I think that's even further taken as you talk about things like blockchain and cryptocurrencies and digital assets. And so it really is on all of us, and thank you for being here and continue to get more educated on the industry. But then we also have to go to Capitol Hill and help members of Congress who are, 80s and 90-year-old and really are challenged to understand what a digital asset is, and really help them understand why this is so important and why it's so important to the average American, why it's important for American leadership, and why it's important more broadly moving forward to give individuals the opportunity to really be the owners of their own future. And I think that education is on all of us, and it's both at the regulator, where they're actually, for the first time, open to hearing from us, but I think even more importantly, as we try setting in stone what is the structure of this market that we want to continue to grow moving forward.
Yeah, I think that's right. I mean, when you think about the industry, building something that's useful, that people can understand how it's used, I think one of the challenges digital assets has had is people in Congress, before they sort of saw the light more recently, the thought was, well, they're just buying this stuff on Coinbase and it's made up money in the internet. As opposed to when Uber came out, people saw, oh, car picks me up, takes me somewhere. I see the value. And I think as more people start to build applications for payments, financial markets, you'll see, we're working on the base level infrastructure here.
Yeah, and I think the one other narrative that I think we really need to work on as an industry is this idea of illicit finance, right? There's this external perception of cryptocurrencies and digital assets as something that is used effectively more than anything else for money laundering, right? Or to help pay for the drugs that are coming into the United States. And I think that's, just if you look at the actual data, couldn't be further from the truth, right? The vast majority of illicit finance today runs through our traditional banks, like 2 to 5% of global GDP. Crypto is actually way harder to use because it's on a blockchain, right? At the end of the day, individuals in the government have access to see how all those transactions are moving. And so I think helping governments understand that, helping us think about, the AML rules that exist today that have not worked, right? Hence why illicit finance is still a massive problem. And the idea of then taking a failed system and try putting it on to something that is actually already inherently transparent is another part of that education that I think we really need to focus on, because again, going after illicit finance is something that I think all of us agree with. We all want to get to the bottom of how do you stop that from occurring. But I think this idea of taking something that's already failed and trying to put it onto something that actually provides more transparency as a starting point means that you're not taking a step back and thinking about how do we actually work together to solve these challenges.
I think that's a great point. I mean, the illicit finance argument is often used as an attack line while ignoring the fact that any way you can move a store of value is going to be used for nefarious purposes and for legitimate purposes. And thinking about the best way to confront that makes total sense. I'm going to ask one question to you guys because I know we only have a little bit of time. What single policy change would most strengthen U.S. competitiveness in digital assets?
So within the Clarity Act, there's a provision that ensures that the spirit of cryptocurrency remains. And this is what's called the Blockchain Regulatory Certainty Act. Don't worry about that term. Just understand that it allows people to build tools using cryptocurrency. It allows open source developers to build tools and not be punished for the actions of people who use their tools. Now, this is incredibly important, right? If every time Apple was responsible for somebody making a phone call and bullying somebody or committing a crime using one of their phones, Apple would not be in business. And so it is very important that we use that same principle when we think about people building using Bitcoin and crypto. So Save Our Wallet, saveourwallets.org. This single provision ensures that we remain decentralized and actually keep the spirit of Bitcoin, blockchain, crypto. And if we lose that, we've lost the plot. We've lost it all.
Yeah, because we're at time, I'll just say I think it's approving legislation that codifies all the things that have been achieved even in the last 8 months. This idea that in 3 years from now or in 7 years from now, this could drastically change because you have a new head of the SEC or a new administration. This idea that we'll continue to do that will always inhibit the ability for innovators like you to create new things. So I think that's first and foremost domestically, but then I always think internationally, right? The idea that individuals in Argentina, places that suffer hyperinflation, won't have access to owning their own digital assets is incredibly frustrating for me to think about. I grew up in Nicaragua, and so a place that struggles to own your own anything, honestly. And so this idea that we would adopt something like MiCA globally instead of something so well thought through like the Clarity Act is, I think, something that would be really detrimental to just humanity as a whole as we think about being able to own your own future.
Amazing. Thanks so much, Chris.
Thanks
And
everyone.
team, and Grant, and
There we go. Okay, perfect. Well, thank you so much, Kevin, and we're absolutely delighted to be here. It sounds like you've set the bar for every panel, so we've been asked to cover AI, the future of fintech, DeFi, all in 20 minutes. But we're up to the task. Kevin already did introductions, and please connect with us on LinkedIn, and we'll be outside after this. But I think I wanted to help set the stage before we get into specifics, because these are each such very big topics, right? So if we think about AI in magnitude, 30 to 40 billion of enterprise investment, and you guys know the trough of the adoption curve, right? So we might have we're well past the peak of inflated expectations, and we might be in the trough of disillusionment and coming out of it, right? You guys might have seen the MIT survey that said 95% of companies aren't getting any value from AI. But then Jamie Dimon just a few days ago said we spent $2 billion in AI, and we've gotten $2 billion in benefits, and this is just the tip of the iceberg. So I think we're coming out of the trough of disillusionment, and people are finding concrete ways to find value. And you guys, when you registered, asked a bunch of questions, and one of them is, what are the real use cases? It's software, so coding. So Bank of America has 17,000 developers, 10 to 20% productivity gains in coding. Same thing with JP Morgan, using a tool. You have customer service, right? You're able to respond faster and with more context. And then you have AI and fraud, so identifying fraudulent payments much faster or payment cards that have been compromised. So those are the big picture areas of AI. Then we turn to fintech, and the commissioner cited some big investments. In fintech, we're kind of at a low of overall investment, and it's focused on real value, right? Making actual margin, not just trying to win customers at any cost. And so I think there's a lot more selectivity, but it's embedded finance. And it's reg tech. We've talked a lot about reg tech. So that's fintech. Then stablecoins. I'm just going to be doing the stablecoins. We hit 300 billion of stablecoins outstanding. That's up from like 200 billion. And 18 trillion in transactions. That's more than MasterCard and Visa last year. And Citi, and you guys can look up, Citi just put out a stablecoin report in 2030. We're going to get to like $2 trillion of stablecoins outstanding in 2030. At 50x transaction value, right? So we're hundreds of trillions of dollars of transaction value. So I'm a digital money lady. This is a next form factor of money. And it's not just going to be stable coins, it's going to be tokenized deposits. etc. So that's sort of your stablecoin world. It's important to pay attention. Then we have real world assets on chain. So this is mortgages, this is consumer lending. That's 1/10 of stablecoins today. But once you get money on chain, then you can get the financial assets on chain like treasury, bonds and money market funds. Some of you guys have seen that. And then you can get into programmable, right? You have the financial asset and you have the financial money, fiat, issued by governments that everybody knows. I love the blockchain, the Bitcoin enthusiasm, but from a payments land, it needs to track money by governments in general. And now with Genius Act, that's the big unlock for stablecoins and the real world assets. Last point, DeFi. Some of you guys might have heard of DeFi, decentralized finance. This is still very early stage, so we won't spend any time on it right now, except that we are getting into creating a new Web3 ecosystem, and how do you do that in much more, because it's growing and important, and Mo has some great leadership ideas on how they are trying to build a next gen Web3. So with that as a backdrop, Mo, you have helped, part of your many things that you do, you help companies adopt AI.
Correct. Yes.
What are some of the successes you've seen, and what are some of the success factors that clients are able to successfully adopt AI?
Well, first of all, thank you very much for inviting me here, for Kevin for putting on such a phenomenal thing. But yeah, I mean, AI itself, there's a lot of hype about AI, and I help organizations adopt it. It's not about AI, it's what AI empowers, what it creates, what I call the tech stack, right? So how you use AI to deliver value for your customers is what matters, not the AI itself. And I actually like what you mentioned about the fact that people rag on AI and saying, oh, the Microsoft report, but we've seen this before. There was a .com bubble. There might be an AI bubble. Everybody was putting AI. There's going to be people who are using AI correctly, and we believe we're one of them. And it's helping us build and scale our product and deliver real value. And I think that's what really matters now with AI adoption.
Great. Okay. So, and we're in our canvassing here. So, fintech, Miguel, you in your role at NBA, you're investing in fintech innovation. What is most important for your bank clients and interests? And I have so many questions for you too on fintech, but let's start with that. And partnership success factors between fintechs and banks. Please tell us everything.
Thank you. So. And thank you, Kevin, for inviting us. So I'm representing the community banks and the minority deposit institutions here. We have 4,000 of those in the US. They serve millions of families and communities. It's not the Wells Fargo or the Chase with billions of dollars in investments. So these community banks are small, and they play a big role in their communities as it relates to financial services, loans, deposits, making sure that the real estate are built and the mortgages are happening. So, and a little bit of context. So I'm a fintech person, now working for a bank, for the banks. What we're trying to do is close the gap that we have in the banking system. So for many, many years, it was a little bit of just like pretty stable way of operating. You have like the big software providers just like servicing the banks. And now, as you described, they're getting waves and waves and waves of new technology. They need to adopt AI. They need to adopt stable coins. They need to think how they're going to do loans in the future. And this is all happening without like any with the same people they have had for like many, many years, with the same software they have many years. So as Mo was describing, I mean, so now what we need to do is create this ecosystem that supports this banking industry as they move forward and they adopt new technologies in a way that's safe, compliant, and secure. Right? So lots to do here, and at stake, there are millions of people out there, right? I mean, so families, I mean, people who, I mean, they think about fintech, they think about technology, but in reality, I mean, they just want to do their daily lives.
For some of the startups in the room, what's the minimum viable product for compliance, or how should they think about how banks vet startups and what's required? We have many startups.
Yeah, I think I'm with Dante. I think his view is perfect. I mean, see, if you're building fintech, you need to build it with a mindset that it's money, and money is a regulated business. So full stop, right? So this needs to be part of your business model. And Can be done, right? I mean, I know that. I mean, when you're a technology person, it's like, oh, compliance, and all this legal framework. I cannot deal with this, right? So, but there are, right? I mean, so there are softwares that you can adopt, and then there are good practices that you can adopt as part of your ecosystem. And the other one, which is the one that I'm representing here, is partnering up with banks, right? So I would like to see like more banks here in this type of events. I mean, we don't have that many. We have Shannon there. But I mean, we have 4,000 financial institutions, right? There are like many partners out there for like all of you fintech persons.
Great. Mo, I'm going to turn to you in Web3 and DeFi space, given you're working at two robots. Yep. Can you please share what is some of the challenges in Web3 and how are you guys trying to create a better model? And how are you using blockchain and digital assets to do that?
Absolutely. So I'm representing two robots. We are reimagining fairness and finance in digital economies. And we're using a game to do it. And I mean, it may seem kind of silly, but I think games are the perfect testing ground for DeFi principles. So we're actually able to build a digital economy through this game that is fair and balanced. Web3 actually has a bit of a bad rep in gaming because it seems to a lot of gamers, especially who just want to have a fun time, like it's going to rob them of their money. There's a lack of trust, and so we are actually trying to build trust because trust is what it's all about. Especially when you talk about compliance, right? Like transparency, custodial, custodial clarity, who owns what when. And then, of course, KYC, like knowing your customer. All of these things help build trust. So we're doing it in a game. Think Monopoly meets open banking, right? Where the rules are fair, transparent, and we allow people to own their digital assets in the game. So when they play the game, everything that they do in the game allows them to earn essentially like their NFTs, essentially, but allows you to own your digital assets that have real value on the blockchain. And so we've made it like a nice, easy on-ramp, and we've made it Web3, so it's native Web3, and it allows gamers to just have fun and basically earn money without even without having to get into the nitty-gritty of finance and learning all this stuff. And we make it fun and easy to get into the finance world, into the fintech world.
Great. Thank you. So let's turn to stablecoins, given its importance. I call it the killer app as a blockchain practitioner, a killer app of blockchain. And Miguel, given your experience in payments land, plus banking now, and in venture, what are some of the biggest use cases of stablecoin that you see? What do some of your, the 4,000 banks, where do you see that? And also looking internationally as well.
Absolutely. So here I'm with Dante as well. So I think that in the US, we're a little bit behind. So I spent 6 months last year in Singapore looking at all the business models that they have for like stable coins. And it's just like amazing what they have built from the federal regulator. I mean, you can get your license and then you can set up your merchant accounts for payments, right? And then you're like a merchant processor for Amazon, for Rakuten, for any of these like online merchants, and you're processing payments through digital USD, digital Singapore dollar. So really simple use cases with stable coins, given that all is regulated, that everybody understands what their position is, and then the economics of it. So payments is one that we haven't discussed here just yet, right? I mean, because I think we are a little bit behind. Stable coins in terms of just like deposits, so that people can do the cross borders. I mean, that's the other one that I think at this point is like fairly clear for everybody. So the banks that I'm working with, all of them for next year, the priority is how they start either supporting a stable coin, offering a stable coin to the customers, and then just participating in the ecosystem. Here the options is, should they build like a platform? Should they partner up with a platform? Should they just do Circle? So there's still a lot of unknowns here, but believe me, so this is front and center for them for next year.
Great. Mo, do you have views on stablecoin? I know you have a native token in your ecosystem, but what's your take?
Yeah, I mean, stablecoin is great. I think one of the best ways to explain it, I always like to try and explain things in as simple as possible. If dollars are our trusted play money, right, then stablecoins are their digital twins. And that's what's great, is that we can map them to dollars. Actually, we pay our developers in stablecoin. And so what we've done is actually a lot of the developers that come through the door, they don't even know about the fintech world. They want to get paid in dollar equivalents. They even ask us to put a clause and say, well, that's the dollar equivalent. But we help our developers onboard to digital currency, and we pay them in stablecoin. And that's what's great about it. It is. I think that stablecoin is the bridge between legacy banking and digital economies, and so it's a great way to get people to build trust in digital economies. And so we absolutely love stablecoin. We use it. Although our game, of course, has this, we call it Tenaxium, but it's a coin, but stablecoin then becomes that bridge for us.
Great. What I would just add here as a digital money lady globally is we're talking about innovation at a crossroads, and I really think this is an epic fight right now. There are two camps, broadly speaking. You have the blockchain native companies like a Circle and tech natives like a Stripe in one corner. Ding, 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 ding. And then in the other corner, you have the banks that have all of the money and customers' accounts. But they don't have the tech. So they have the clients and the distribution in the main. And so the question is, who's going to win? And we don't have enough time to go through all the developments, but maybe think of the tech and blockchain camp as Tesla. That's very techy. And then the banks are kind of like Ford. They have mass distribution. And all the banks just announced literally 3 days ago a consortium for stablecoin around G7. Some of you guys might have seen that. Citi, Goldman, Bank of America, lots. Stripe just announced they're going to help their customers issue stablecoin. They launched their new layer 1. So did Circle. So we are really in a big, food fight. So it'll be interesting, but it showcases the importance. And the big implication is, and as a banker, I was at Citi for 18 years. For the first time with stablecoins for the instant rail and tokenized yield-bearing products, you can peel away operating accounts from the banks. So you no longer have to keep your money in a bank or all of your money in a bank. So that's what's at stake. But if that happens, then lending could get more expensive. So it really will, because the banks are the ones, they take in low-cost deposits and they lend them at higher rates. That is the core of banking models. That's how they make so much money. So anyway, we're in interesting times.
I wanted to quickly
ahead.
add to that, actually, which I had to look it up real quick, because I remember my brother and I, we trade back and forth, and he was telling me stablecoin just announced that they have over 300 billion now in market cap.
Yes.
So and that's 18% growth. So I mean, it's
even more.
This is adding to your point right there.
Yeah, going to maybe 2 trillion and then 50x transactions. So good. Well, I'm going to ask another question about what areas of fintech you guys are particularly excited about. You reeled off a bunch, Miguel, and so for folks in the room that are building businesses and VCs that are looking at them.
So we have still a gap in providing credit in the US, right? So if you're like a subprime borrower, you have very limited access to credit, right? And the problem is that the traditional FICO scores are hard to use for this demographic. We need a new model, right? I mean, I know that many of you are testing the waters in terms of should we do cash flow underwriting? Should we do some other using social accounts? I mean, just to do the underwriting. But that's still a big area that's open, right? I mean, to extend that we can convince Freddie Mac and Freddie Mae to use this model of underwriting, then those will become mainstream, right? Because unfortunately, if you want a mortgage, you need to use a FICO score. I mean, that's the only option. But we need a way just to include more people into the economy. And the other one that I know that eventually this is going to happen as well is just a little bit more intelligence into how the financial products are sold, present, and positioned to the customers. I mean, there's a lot of unknown and gaps in financial literacy for the general population. It's not that this is something that they go to school and they learn. So we all need to learn how to use a credit card, how to apply for a loan, how to maintain a loan, and all those things. I think that with the LLMs and the AI, I mean, they'll become better.
Totally. I would just add a couple of facts on that one. Cash-based lending, which we don't do. There's over 100 million of Americans are excluded from the credit bureaus, right? So you need to have a credit score to get credit. So that's stupid in that sense. So if you can plug into the customer's bank account, you see, their recurring payments, et cetera, you could do much more cash-based lending. And then financial wellness, you need to have $1 million in the bank to talk to a human kind of thing, right? That should not be. I'm spending all my time on AI land and what problems can you solve with Gen AI that you couldn't solve before. Having a wellness advisor and educator of, the basics that go a long way to accumulating wealth over your whole life is really important. And there's a lot of wealth tech, I'd say, fintechs coming out. Thank you, Miguel. I'm going to turn to you on AI challenges. Like, what are the common mistakes when you're advising your customers? What are the things they're not quite getting right that you're helping them with?
Well, I actually want to talk about AI opportunities
Please, go
because
ahead.
I flipped the script on you
Yeah,
here,
do
but
it.
the challenges are actually opportunities in disguise. We use
Yes.
AI strategically. I mean, absolutely. And I think the biggest thing when it comes to fintech and the intersection there is it's all about composability. It's how we use AI to verify blockchain truth. Right, blockchain data, and so as AI begins to be able to reason over that blockchain data, we're going to see this grow at scale. And actually, we're seeing that already right now. Our Two Robots Studios, we use a company called Third Web. And this is basically like the Stripe for Web3, and their whole thing is, they're the ones that handle all of our KYC stuff. We can build smart contracts within Third Web using AI. There's a company right now, another company similar to Third Web called Halliday, and actually they're named after, I don't know if you know who Halliday is, but Halliday from Ready Player One. But anyway, they use AI to be able to build smart contracts like Lego blocks.
Okay.
So it's how we use AI in the fintech world that I think will matter. So strategically is really what it's all about.
Great. And our
Yes.
last lightning fire, the biggest fintech innovation that will make the biggest impact in the next 12 months.
Partnerships between fintechs and banks in a way that's more sustainable. So there's still only a few banks that do partnerships. I mean, we can probably count like 10, 15, 20, but if we have 2,000.
Got it. Mo?
As I said, composability, the ability to be able to put the technology together in a way that creates trust, transparency, and a great user experience.
Stablecoins is the next form factor of money. Thank you.
Amazing. Thank you, everybody. Please. What's that? I'm going to run through kind of the themes that were asked, and then we'll jump into the first question. The current White House administration status, the balancing act between regulators and innovation, AI and digital asset convergent, national security lens, collaboration versus control, and global competitiveness.
All of our favorite topics.
We have only 20 minutes for this. So first question, from your vantage point in national security policy, how does the current White House administration's approach to fintech and digital assets differ from previous ones in tone, priorities, and willingness to engage?
That's an interesting one, because I do feel that there's been some level of fracture and consistency across many administrations focusing on fintech policy. For example, under Trump 1.0, when I was at FinCEN, which is the U.S. anti-money laundering regulator at Treasury, it was widely reported how President Trump was very much not a fan of cryptocurrency and even potentially was pursuing ways to ban it. But also at the same time, we drove the adoption and creation of the first ever standards for virtual assets at the FATF, or the Financial Action Task Force, which is the international standards body for AML. I was FinCEN's lead delegate to it, so we worked on helping to create some of that regulatory clarity of expectations and standards internationally on how to stop illicit actors' exploitation of crypto. Then under President Biden, we issued the first ever executive order for digital assets, which included an acknowledgement of the risks, focusing on responsible innovation, trying to drive a competitiveness strategy, and the first ever strategy from the Department of Commerce, which I know is in the room right now, one of the key architects of that, to do things like driving R&D and standards work in crypto, but then also seeing some guidance from banking agencies and others that seem to be very counter to wanting some of the more traditional players to play in crypto. Then certainly under the current administration, where I'd say in the term responsible innovation, under the Biden administration, I think the word responsible was in all caps. Under this administration, the word innovation is definitely in all caps. So a major focus instead on, certainly they've created an AI and crypto czar in the White House, and he's been focusing a lot more on trying to make sure that we create an environment for competitiveness for the U.S. At the same time, we're dismantling a lot of the enforcement apparatus and firing regulators. So while we've created some historic legislation and frameworks for things like stablecoins, which is critical for U.S. competitiveness, we've also been dismantling some of the apparatus to ensure some of the responsibility there on that side, which creates an opportunity for industry to step up to be some of the experimenters and the creators of standards and other R&D. But I think there's some interesting tensions across many administrations on fintech policy.
Amazing. And kind of that's a good segue into how can regulators encourage fintech innovation without compromising financial stability or national security?
Oh, this is really a critical one, because I do think like the U.S. is still such an amazing place to be the home of innovation for technology and in finance. We have a rule of law that is believed in. We have really liquid capital markets. We have an incredible technology apparatus, and just really secure and trustworthy financial systems. So that is a really great standing upon which to build and to allow fostering innovation in the ecosystem. I'm concerned about certain trends around dismantling certain enforcement capabilities, and if we don't put in place some of the stronger guardrails, what that will do. But I think that that's where startups, and especially what a wonderful place to create the competitive advantage that I know Dante was kind of speaking to earlier, the competitive advantage that startups that are either based in DC or focused on the DC environment have. Because I think that right now, the next age of fintech innovation is going to be about building on and leveraging this trustworthiness index. Like I think, especially now with the passage of the Genius Act and digital assets, with a lot of experimentation that's happening in AI, where some of the challenges that you have with these technologies are because of some of their nascency and the development of the more complexities of the system, things like built-in pro-cyclicality, like that can be automated, which can be good, but also really bad if things start happening in a bad way, like that presents potential stability risks. On the national security side, we see the issue with cryptocurrency. One of its features that creates resilience against cyber criminals from taking over the network and targeting it also inhibits resilience on being able to recover from breaches. Like, I don't know, I'm gonna poll the audience. Who here knows that the largest heist in history occurred earlier this year? Awesome, so a few hands. The largest heist in history occurred earlier this year in February, where North Korea stole $1.5 billion from a cryptocurrency exchange, and we have recovered very little of those funds. That is a problem from a cybersecurity perspective and from an illicit finance and recoverability of assets. These are solvable problems. We can work together, and this is where startups and innovations in tech and operational solutions can help solve these. And I do think that DC, which is the hub of national security-minded professionals, some of the best security firms and people are sitting in this room right now, I think that that kind of policy and security mindset needs to be injected into some of the like move fast and break things ecosystem sometimes of Silicon Valley. So I think DC is a great place to hone that kind of innovation.
Amazing. And we can't talk about innovation without talking about AI. So what are the biggest emerging risks or blind spots as AI becomes embedded in financial technologies?
And AI is a really exciting one because I think that the tension points between the benefits and the potential costs of innovation are nowhere more present and observable in the technology space than in AI. Like you have this democratized access to incredibly sophisticated, higher order like economic developments and thinking that you get with AI. Like I know that when ChatGPT was launched, like many of you have been building AI, using AI, whether in compliance in your solutions, operating those companies for years. Like AI isn't new. Like one person's logarithmic regression is another person's AI and machine learning. But now what is totally new in this generative context, the advent of democratized access to really, really sophisticated AI. And now where natural language is the user interface, is the UI. English or like any language really is now the UI. This opens the door for people who are not inherently really tech savvy or coders or programmers to have now access to really, really incredible, like sophisticated thinking. So I think that's a wonderful use case that already has been used in compliance and chatbots and algorithmic trading. We've already seen AI used a lot, especially in back office functions. But now we have these risks, again, of like automated pro-cyclicality is a huge concern that I have from a stability and a contagion risk sort of issue. The explainability and black box issue is also, I think, really present. as a huge concern around where there's bias that can be built into the algorithms towards like certainly undesirable outcomes, but also just like inaccurate and erroneous findings. So I think that that's where there's some blind spots that need to be addressed, but also a really great point that I think helps to highlight the interesting convergence of AI with other emerging technologies. I love talking about this with AI and blockchain, where they converge in very cool ways because they solve each other's problems, but reinforce each other's best and worst traits in fascinating ways, right? Like AI has this explainability and data integrity problem, right? Blockchain was created for provenance and data integrity. What a wonderful solution to potentially help solve in this issue. Where blockchain has faced scalability issues and compliance challenges, AI can be part of that solution. But also where you have scalability, maybe in decentralized networks where you have lack of clear lines of accountability and responsibility built in, think about scalability on top of that lack of clear accountability with the challenges that potentially presents. If you want to really potentially scare yourself, something that I did in Japan 2 years ago at the FinTech Festival, I pulled up ChatGPT and I was like, ChatGPT, if I deployed you on a decentralized network and you started to operate maliciously or just erroneously, like just not even from a malicious vulnerability in your code, but just an erroneous misallocation of assets in a treasury or whatever, could I stop you? Could we take you down? And its answer was fantastic. It depends on how decentralized I am, how good my security is, and how good your authorities are. And I was like, ChatGPT, that's a great answer. That's a great answer. So this convergence of these technologies, I think, presents really cool opportunities, but also we need to think very specifically about the way that they operate, about the kinds of guardrails operationally and technologically that we need to build into them.
Amazing. And kind of shifting to your national security lens, which I think tags to this very well. You've advised at the highest levels on cyber and critical infrastructure. What's the one thing Washington must get right about digital asset oversight this year and over the next 3 to 5 years?
It's a great one, and it's hard for any national security professionals, and I see several of you in this room. It's very hard to take off that national security hat, so sometimes we have to we have to make sure that we're keeping other aspects in mind around things like consumer protection. But I do love the national security lens because I think it's one that inherently demands balance, and this was demonstrated even in the Biden administration. When I was at the National Security Council twice, we saw this very present challenge of the fact that digital assets is a great example of the fact that like this technology remains the primary use for cyber criminals to conduct a lot of their laundering activity, right? Like that is not an accident. That is not an inevitability because as technologists and national security professionals, we understand that I don't know why all these criminals are publishing their transactions on public, unobscured ledgers. I hope they do it forever. I hope all criminals decide to take an approach of radical transparency. I think that's fantastic. The problem is that if we don't have a comprehensive, interlocking ecosystem of compliance and controls, then even being able to trace where the transactions are, if that's sitting in, if it's an alphanumeric string, representing the public address and wallet where these assets are, if I can't get a hold of them, how useful is that to me, really? And then, of course, there's lots of obfuscation measures that are coming in place to make it harder for national security professionals. But then there's also the competitiveness angle that was first and foremost in our mind as well. Like we see the fact that we have alternative payment systems being pursued by a lot of our adversaries on the geopolitical stage. So this broader issue of like trying to figure out what is the right balancing act between stoking innovation, making sure that we are not that we do not allow for the hubris of believing that everyone will sit and wait for us, and that we are jealously guarding the amazing economic benefits and national security benefits that we get from the U.S. being playing this incredibly central role in the financial system. That is something that we recognized what the challenges are that come from DeFi when all of a sudden you, between lira and renminbi, if you don't need to go through correspondent banking and US dollar accounts anymore, what does that do to my ability to leverage sanctions or to get visibility in the anti-money laundering world? But also, you potentially also get the benefits of extending the dollar if US dollar denominated and properly regulated and secure stablecoins allow for the extension of the US dollar. That could expand reach. Now that presents some other interesting economic questions that also impact national security. So first, just saying that a holistic approach must be adopted. I do think for DC specifically, thinking about things like making sure that there are clear clear guardrails, that clarity of regulation to know how to operate and what is the North Star on making things secure and recoverable, including for when people get robbed and when consumers are defrauded. No one likes getting robbed. So I think that from that perspective, things like cybersecurity and things like anti-money laundering framework, and then making sure that you have the ability to oversee iteratively and often, because that's what you need to keep pace with the current scale of the amazing innovations that are happening in this space. Those are some of the key pillars, I think, cyber, AML, and then focusing on making sure that you have the oversight apparatus.
Amazing. And leading into that, how can agencies, innovators, and investors work together more effectively? What's missing from the current dialogue?
Agencies, innovators, and investors. I love that you included investors because so there's two key sectors that as a regulator that like I know I and many others really looked to often to get an idea of, hey, how are we doing on assessing risk in an ecosystem, in a market? Investment and insurance. They are naturally in the business of hedging and assessing risk, right? How are they doing in this sector for being able to assess and understand and manage risk? Unfortunately, I don't think that we have a great news story for digital assets so far. There has been some maturization, though, so that is good news. But unfortunately, we saw lots and lots of money going into this space without really good due diligence practices that was happening. There were lots of like pump and dump schemes that were funded, certainly major cybersecurity issues that existed, the kinds of things that normally we would look to the insurance space and the investment community to expect and demand of companies that they would invest in. So that's, I think, a really great opportunity. And I'm excited and I'll dare to be optimistic about some of the positive trends that have been happening on that space. But I think that the absence of there being, and I know standards is not, it's everyone's favorite word to say in DC, and me too, I will defend it day in and day out. Basically, there's a lot of standards that already exist that have not been implemented at scale across parts of the fintech ecosystem. This includes AI as well as digital assets, whether it's the NIST privacy framework. I've never seen anybody use that and apply that in the fintech space, and especially not in digital assets. And then also, like there's the cybersecurity framework and the secure software development framework. Neither of those have I seen being clearly and systemically adopted across the ecosystem. I think that some of those are some of the basic parameters for due diligence and making sure that we're meeting some basic barometers of this is what maturity looks like in digital finance. And what we expect when you choose to get in the business of handling other people's money, we expect a higher level of security and responsibility.
Great, thank you so much. Let's position or switch to global competitiveness. You mentioned South Korea and the renminbi. How do U.S. regulatory decisions today shape our position relative to Europe and Asia in the global fintech race?
It's, again, I think there's one of some tensions and some fracture, but we certainly saw where with the MiCA framework that in Europe, and also Europe has really been more front-running on some of the establishment around technology standards and regulation. I think there's some good reasons for that, and also some good reasons why the U.S. hasn't been at the forefront of a more national framework around things like we don't do national cybersecurity regulation. We do it by function. Like if you are a healthcare provider, that's how we regulate you, including measures like around cybersecurity for financial institutions. Like we tend to regulate not the technology, but instead the function, because it's that activity that is high risk. I think that in the U.S. we've had some tensions and issues on trying to figure out how do we regulate these really innovative and emerging technologies that present some fascinating scaled risks at a much higher speed that in Europe they've been much more willing to adopt, but which I think unfortunately in some cases has stifled and smothered some of the innovation early on. So there's us being behind on creating things like a clear pathway into regulation and oversight that we desperately needed and that many of us fought for the past 6 years in areas like stablecoins because we don't have a payments charter in this country. We should, and that's how we should have covered them in the first place. But that So I think that that's where we were behind, but the fact that we're mostly approaching these things now from an activity-based regulatory function and risk-based versus one that's specifically regulating the underlying tech, I think that that will create an opportunity for advantage here. And again, the U.S. can still leverage the fact that we are the home of such amazing technological innovation, amazing liquid markets, and so I think that there's some great things that we can build on top of. In Asia, though, there's just this huge influx of experimentation and R&D that's been just absolutely happening unmitigated. So we need to be thinking about that and looking to where, again, alternative payment systems and technological infrastructure are being adopted that go outside of our reach, our visibility, that are not implementing things like democratic principles built in by design from the beginning. That's something that does concern me because their regulatory frameworks are not as strong and safeguarded as ours. I'm also worried just about us dismantling enforcement. If we have rules that are not implemented, it's pretty feckless. So I'm kind of worried about where some of those tensions will come in as well.
Understood. Thanks for that. So your key takeaway, we have about 2 minutes left. If there's one principle or mindset you hope everyone here carries into their own work after today, what is it?
Vigilance. I know that sounds like a national security professional. That's only because I am that. So it's highly predictable that I would say, but vision and vigilance. So I'm sorry that's two words together. I think that's what you need. Any frontiersman had to travel out west, having both vision but also vigilance. Like those who did not protect themselves or defend themselves and make sure that they were prepared and ready for systemic shocks and security issues, like they would find themselves being exploited or other worse things that were happening. I think that you need both. You need to don't ignore these amazing emerging technologies. Figure out how to use them and leverage them and integrate them into your systems. Also engage early and often with the regulators and policymakers. If you are here in DC, what an amazing location to be, and with an administration and with a city that is so interested in embracing these technologies. It's a wonderful place to be that can allow for you to figure out what is that competitive advantage for, again, the trustworthiness index that I think is going to win now that we've opened the door to some of the more adults and the traditional financial players to engage with these emerging technologies. I do think that this is where, people that are very used to operational risk, systemic risk mitigations, things like cybersecurity and AML, they are coming to play. And when it comes to money, Americans and consumers are not willing to accept as much risk in messing around with their assets as potentially you can do in just the tech ecosystem. So I think fintech is cool because you have a neat mixing of these technologies together. But I think that thinking through how you both integrate that vision and vigilance together and leverage the competitive advantage that you get for that trustworthiness factor by being placed here in DC.
That was awesome. Thank you. I'm breathless. Thank you so much. Appreciate it, Carol. This was so much fun. Yeah, absolutely.
I will just do a quick background introduction. My name is Pierre Roosevelt. I am a vice president at Aon. I am part of our life science and technology practice. Been in the insurance industry for 10 plus years. Prior to that, I was in a global technology role building out infrastructure primarily in the European and Latin America markets. Fun fact, I'm fluent in 4 different languages. Pierre, that is my native tongue. Speaking French, I speak French, Spanish, English, and Portuguese. Excited to be here today, and I will pass it to my next panel member.
Hi, everybody. I'm Dorothy Giobbi. I'm counsel at Alston & Bird, and I work with clients in the fintech and emerging technology spaces. Before private practice, I was in-house at a large financial institution for 10 plus years supporting emerging tech initiatives across the bank. Thank you, and great to see everybody.
Hi, my name is Adam. I'm the CEO of a company called Inca Digital. We do risk intelligence in crypto and fintech. So kind of think of us like Palantir for crypto. But then we also do a lot of recovery efforts too. So a large part of our business now is if you had crypto that was stolen or hacked or you were defrauded, we're fully vertically integrated where we not just do the intelligence work, but then also file lawsuits to go and get that money back, both for companies and starting soon for individuals. Background is in military intelligence. Nice to meet everybody.
Thank you. So today's questions we have are actually from the audience, so very targeted. I'll go off the first question. How can AI strengthen compliance and fraud detection without creating new attack surfaces?
It's not a cure-all, obviously. Part of the issue, I'll kind of tell you where we're at Inca at the very least, where it helps and where it hurts. So at any large financial institution today, AI is important, right? But there's basic shit that they need to get right first. And if you've worked in a financial institution, you know what I'm talking about, right? Like, we're still using Excel spreadsheets for the most part to do our analysis. So data, wider ranging data integrations need to happen first in order to be able to even use AI in a way that is sustainable and actually has an impact on risk at those companies. Where we are, we're a fairly small cutting edge tech company. We are able to use AI to analyze particular data sets. So we can analyze trading data with AI. We can analyze social media data with AI. We can analyze blockchain data with custom built AI models, typically on top of Llama models. The issue that the next step in this is combining heterogeneous data sources together, just shoving a bunch of stuff at the model and then the model figuring it out. And there's some programs to do that. So if you guys know DARPA, they haven't made any decisions yet, but they've publicly said they're coming out with this program called A3ML, which is essentially exactly that. Taking social media data, blockchain data, fintech data, TradFi data, and shoving it all into one singular model, and then it comes out the other side. What risks are there? You can ask it questions, everything like that. So we're getting there, but it's not a panacea, at least not yet.
Yeah. So I guess I would add that it's true, obviously, that using AI or machine learning can be additive or improve compliance programs. And particularly in some areas, it's a regulatory expectation that it be used, depending upon the product or service, how it's being offered and where it's being offered, or whether it's being used for internal purposes. So a lot depends on use case. Use case drives the risk, always. I guess I would say that the most important thing that I've seen, and I think what I talk with clients a lot about, is governance of AI. So it's great to use AI tools, and there's a lot there available on the market. And whether it's homegrown or through a vendor, governance of that AI system or that AI tool is something that we've been very focused on. We think a lot about, and that includes the models themselves, model governance, but data management, all of the things that are feeding the AI tool or that the AI tool touches have to be part of a larger governance system. And so I think having that in place, having that kind of governance in place, allows you to use the tool to reduce compliance risk and not creating new risks through use of the tool itself.
I'll chime in as well too. So from an insurance perspective, we typically recommend, if you're going to deploy or leverage AI tools, always look at your insurance policies. The most relevant exposure or exclusion we're starting to see on policies are AI hallucination. So always look. There are certain carriers now that are coming out from the Lloyd's of London that will provide you with coverage related to AI hallucinations. I will jump to the second question. What minimum security posture do investors expect before funding fintechs?
Sorry, say the question one more time. Minimum security posture for when VCs are looking at fintechs?
What minimum security posture do investors expect before funding fintechs?
Yeah, they don't care. That's the answer. It's an afterthought. And in some ways, it kind of should be, right? I mean, it just depends on It kind of depends on what you're doing, obviously, and like where you are. I'm not talking about like OpenAI, right? But like if you're like, you know, like when Inca got started, we started in 2020, you know, they like take a glance at it, right? But it's, if you guys are, if any of you are, you know, starting your own companies, you know, you have to weigh and balance, right, your business operations with how much you're going to get into compliance, how much you're going to get into security, and all of those things, right? It's important. You don't want to kill your own company, right, or get hacked, which happens all the time in crypto, as you know. But also, like, don't overdo it either, because VCs don't really care. If you've got a good business model, if you're making money, that's what matters more, honestly.
I would just add that I think it depends upon where you are in the cycle, and eventually having, you know, appropriate policies, procedures, governance in place will become important if you want to take things to the next level.
Oh, you're just saying that because you're a lawyer.
Well, but it's right. So
you're not wrong.
So I think it, yes, obviously important to get to market and scale products and services, but don't leave those very, very important considerations around policy, procedures, compliance until you're at a point where you're having to sort of retrofit all of that. Take it into consideration. Obviously, the focus on growth and legal and compliance should be supporting and supportive of that growth. But you know, really to sort of to really be successful, those things are going to become very important.
Yeah, I mean, it's true, especially for later rounds. So if you guys are looking for like a seed round, matters less. If you're looking for like a B or C round, matters more. That's absolutely the case. Yeah.
Yeah, I just want to chime in as well too from a D&O perspective. What I've seen with VCs and private equity, I kind of do agree with you. I'm starting to see a lot of outrageous AI valuations on companies. We're seeing a lot of shift between, let's say, life science companies just shifting and leveraging AI, and their valuations are 2x, 3x multipliers because they're leveraging AI. From an insurance and risk perspective, I would say for any founders or VCs, just be conscious of your statements on what your AI product or tool does. We are starting to see exclusion on D&O policies with regards to AI washing. AI washing is basically when you exaggerate what your AI tool or product can actually do. So there have been some class action lawsuits related to that. But yes, I do see that VCs are just throwing money at anything that says AI. It's kind of giving me a similar vibe of the crypto boom. When anything crypto digital asset, they were just throwing money at that as well too.
Yeah, just to add on the AI washing point. So the landscape of litigation related to AI is interesting, and but AI washing, that is the sort of the promotion or the saying that you're doing things with AI or you're an AI company, and really that's not the case. Several cases have been brought by the SEC. There are other regulators looking at it very closely. And so it is an area of heightened sensitivity. So, the statement should match the actual function, products and services. I just wanted to emphasize that because it has been an area in terms of AI washing that the regulators have cited.
And I will say just the biggest example there was, I can't recall the name, but there was a company that sold an ordering machine learning system through, let's just say, like your Dunkin' Donuts or your McDonald's. If you ever pull up to the drive-thru, it says, "Can I take your order?" and it never works. You have to kind of repeat yourself several times before a live human actually takes your order. I think there was a lawsuit roughly around $80 to $100 million for that product being sold because it never delivered. It was supposed to create efficiency through the drive-through systems, and it was supposed to eliminate some of the workforce, but that product itself isn't able to interpret the actual order that you're submitting through the drive-through. So
that's just because it's modeled off of the people that were there before that also can't understand what you're ordering.
All right, so we'll jump to the third question. How can smaller fintechs achieve enterprise-grade security affordably?
So, thinking about it from sort of a legal perspective, there is a lot about, fintech, larger institution partnerships. So to the extent that, those partnerships exist, leveraging some of the security apparatus or mechanisms of a partner, for example, is one way for a smaller fintech to think about scaling up on the security front.
I'll chime in because I work with a lot of small fintech, Series A, Series B. What I will say is, from a insurance perspective, your cyber policy does have it. There is about 5 to 10% of allocation towards that premium that will allow you to invest into pen testing and certain tools that can help with your cybersecurity posture itself. So, as a small fintech company, everyone thinks that insurance is more of a reaction tool, where you can actually use and leverage it as a proactive tool. So your cyber policy, anything that I would say is you're paying that premium anyway, if it's $25,000 annually or $100,000 annually. Again, there's about 5 to 10% of that premium that's allocated for you to go out and actually do pen testing or any ISO certifications, anything to make sure that you have a robust risk management program. So use your insurance policy to its full capacity, not just only at a renewal stage.
Wait, sorry. So you can use your insurance policy to cover the cost of pen testing?
Many of the carriers, they do. That's a little sneak secret, so I'm sharing it aloud. A lot of brokers aren't aware of that, but yes, that language is in there, and you can negotiate. You can negotiate at your renewal. I would say if you do negotiate at your renewal, find out what that renewal indication is going to be, that initial pricing, and then say, hey, I want you guys to also cover my pen testing. If it's $15,000, $20,000 for the year, you can negotiate that and add that onto there. But yes, there's typically about 5 to 10% of your premium is allocated to enhance your cybersecurity controls.
Every time I do a conference talk, I always think like I'm missing 2 sales meetings to do this, and I'm losing money, right? This one, you just made me money. I would say that, like, from the tech perspective, you can outsource it for the most part. So like if you're building a stack, microservices architecture, you shouldn't be like reinventing the wheel, right? For the most part, and it depends on like what code bases you guys are using, but for the most part, you can outsource to good companies that know what they're doing your security infrastructure. You're in AWS, you're using Cloudflare, you're working in Java, whatever it is, everything is there. So you don't need to do anything from scratch. Just depends obviously on what you're doing and what your stack is. But if you go microservices, most of it's taken care of.
All right, I will go on to the next question. This is a fun one for me. How should companies communicate breaches or risk transparently without losing customer confidence?
So I have to say, from a purely legal regulatory perspective, there are rules around breach and what has to be communicated to regulators and when. So as a starting point, in the event of breach, or thinking about scenarios for a breach, know what the disclosure requirements are. Very, very important. That's a different question from the sort of customer trust issue, and I think that and there are there's some when you report to a regulator, there are certain things that you can say and you can't say, and what you can disclose and what you can't disclose. So that drives a lot, I think, of how you are able to communicate with your customers. And the reality is, in a breach scenario, you may not know enough to communicate, because what you don't want to do is go out to customers and say something, or factual statements, and then have to either retract or explain things in chunks to. So you want to make sure that you have a command of what's happened before you go out to talk to the customers. I think regulators understand that the situations sometimes are fluid. But you're as a general matter in communication with them, sort of constantly. Customers are a different story. I think there it's really you have to communicate, sort of not what you say, but how you say it. It's a delicate balance, I think, to maintain that trust. And with the facts may not be complete as you have them.
Yes, so from a insurance and risk perspective, it's an interesting landscape, especially with regards to publicly traded companies that have a duty to announce that there is a breach across their network, which can impact their stock or their market cap. So anytime communicating through a PR, I typically would advise on having that part of your incident response plans. So that should be discussions early on and preparation early on, and your responses should be swift. You should never let your customers or the public kind of generate their own thought process behind it. So it's something that you should address in a timely manner, effectively, and then just working with your team to make sure that the message is not only demonstrating that you are handling the risk post breach, but that you are also communicating and just being transparent as possible.
Yeah, I agree with that actually. Most companies don't have a response plan. And if you're dealing with retail, whether that's financial retail or something else, you need to have one, and then you just control the narrative afterwards. And if you do that well, people are going to maybe lose confidence in your product, but they'll also give you kudos for handling it. So a really good example is the Bybit hack, if you guys saw that. So Bybit it's a big offshore exchange, largest hack in history. $1.6 billion was stolen by the North Koreans. Bybit, I mean, they didn't have their shit together at all pre-hack, but they did a good job post-hack with communication and handling it, right? So they covered down on customer funds, gave live updates throughout the entire process as to where they were, and they largely handled it and survived. Despite it being a massive blow to the industry. So you can come back from it if you just communicate openly and obviously with whatever regulatory or law enforcement communications that are required. But other than that, yeah.
With regards to digital assets, anything crypto related, I've noticed a lot of companies, like similar to Coinbase and Ripple, they will disclose how much limits are being carried, which I think builds consumer confidence whenever they disclose that, hey, we do have a crime policy in place, so if something were to happen, we're able to reimburse you quickly or use our insurance. The issue, I won't say the issue, but my concern with that always is you're advertising to threat actors or bad actors like, hey, we have insurance, we have $50 million limits, or we have $100 million limits, and I think that kind of accelerates anyone trying to exploit them. But I do think that, yeah, it's a double-edged sword, but I do think that it's necessary to disclose that to consumers to help, again, instill confidence that if something were to happen, there is some type of reimbursement mechanism or some type of insurance to back them from a dollar perspective.
Shameless plug, they call us.
Great. Pierre, Dorothy, Adam, thank you so much. This was a fantastic panel. So everybody, a round of applause. And we will, Pierre, do you want one closing remark?
Just want to thank everyone for coming out today. Make some noise for our panelists today. Excellent job. We'll be around to answer any questions. And thank you guys.
Amazing. Thanks so much.
Pleasure to be with everyone here today. Thank you again for coming to our second annual DC Fintech Summit. My name is Tamara Zaiden. I am the director for the DISB, Department of Insurance, Securities and Banking's Office of Innovation. Excited to moderate this panel, Navigating FinTech Innovation in DC, Opportunities and Resources for Growth. We have a dynamic panel. Everyone will introduce themselves, but before we do, 60% of the audience is, it stated on the sheet, founders. So by a show of hands, can I see how many founders are in the room? Wonderful. That sounds about right? From our view, looks good. Well, wonderful. We're excited to share what the city has in store for you. I'm happy to kick it off by just sharing a little bit about the office, then going down the row here. So the Office of Innovation was founded about 3 years ago this month with the goal of building out the DC Fintech ecosystem here in the district. We really look to support fintechs by providing regulatory guidance, connecting you with resources, whether it's through our government agencies or other stakeholders in the ecosystem, and really be that, provide that clarity on any type of licensing or regulatory that you may need to operate in the district. And so I really hope that if there are any fintech, regtech, or insurtech companies in this audience that you stop by and learn more and make sure that we connect before this event is over. So with that being said, I'll pass it over to Chris.
Hey everybody, thank you for the opportunity to speak today. Last year, they allowed me to speak for 25 minutes, so now they just cut it down to 5. Now I'm Chris Dovis, I'm the founder of Phone Bank, but we do emerging market stablecoin payments. And what's interesting about it is that this is my 4th venture where I've been in DC, and I've exited 3. I sold my last company to SoFi. We enabled college savings, student loan repayment programs. And then our first venture really was enabling the U.S. Treasury Department to accept payments from citizens, right? So you think about it as DC a fintech as you can get. And you know, through this experience, I also fell in this rabbit hole called crypto and stablecoins, which I think is changing, you know, how people think about financialization and what fintech is in as it progresses. But through this experience, I've learned a lot about sort of framing, you know, go-to-market regarding sort of regulation, capital formation, and how to navigate some of this complexity. And I do think, you know, and I'll talk to more, I'm sure Tamara has a bunch of questions for me, but like, being here is a competitive advantage. And I think even more so with sort of the new dynamic in terms of fintech and the blockchain.
Thank you. Hello? Okay. Super excited to be here. Like Kevin mentioned, I'm Joseph. I'm from K-Street Capital. We are seed-stage investors. We like to invest in regulated markets. And kind of the big reason why I joined on is we partnered with the Deputy Mayor's Office and with Adam, where we are launching the inaugural DC SSBCI funding. And so our program is looking to support and fund early stage investors and fund managers that are committed to investing in DC. And so a program that's we're newly launching. And so we're super excited to be kind of supporting and going alongside fund managers and also kind of new emerging ventures in the region.
First, thanks for having me. I know it was last second, so thanks for squeezing me in. I'm Perry. I work at Build Within. We're a workforce development and technology company. Also started my career at Capital One in their credit analytics. And some of you fintech folks might be thinking, what does workforce development have to do with fintech? Not going to answer that right now because I want you to stay, but stay tuned.
Good afternoon, everybody. My name is Adam Lattimore. I'm the Director for Technology and Innovation with DEMPED. So that's the Office of Planning and Economic Development here with the district government. My portfolio, in addition to the SSBCI fund that Joseph mentioned, also includes the new Technology Ecosystem Fund. And I also work with our business development team on the Vitality and Growth Fund, which is some of our main business attraction tools. In addition to that, I also work with the team as well as advising the Deputy Mayor on just generally how we can diversify the district's economy towards technology and working to build partnerships with universities, anchor institutions, startups and founders like many of you here in this room to make sure that the district can become, you know, one of the best tech hubs in the country.
Amazing. Thank you, Adam. So with the number of founders here in the audience, I'm sure they joined because they want to know what types of funding is available through the city that they can leverage. And so at our last summit, we announced the Tech Ecosystem Fund that was launched through the Deputy Mayor's Office. And so we wanted to just learn about any updates that you guys have and where you are right now. If you could share, Adam.
Sure. Yeah. So we were really excited at DemPed to have approved by the council 2.45. I should probably just say $2.5 million for the Technology Ecosystem Fund. Essentially, what that's going to be for is supporting the growth of startups, the increase, the number of founders and entrepreneurs here in the district that are aligned with some of the verticals that we've identified through our sector strategy, which we have done over the last couple of years. And so for those who maybe are hearing that for the first time, the district went through a process by which we identified the types of technologies that we think we are best positioned to sort of grow within the city limits. And those look broadly like AI, cybersecurity, fintech. We've also seen some climate tech and some defense tech sort of naturally bubble up as well. And so we're looking at ways that we can sort of support the proliferation of those technologies and the success of those companies. So we're hoping to do that through the Technology Ecosystem Fund. We have that funding for FY26, and we're going to be prioritizing incubators and accelerators that are aligned with those verticals, but also other events, ecosystem partners, and other creative solutions to some of the challenges that we're going to be identifying through the RFA and the application process. Our hope is that we're going to be announcing this in the coming months. We want to make sure that funds are deployed in FY26 quickly. And so if there are, programs, if you run an incubator and accelerator and you want to learn how you might be able to get access to some of this funding, I encourage you to reach out so that we can talk more about some of the cool things you have. In addition to some other funding, if I may, I think, the Vitality Fund and the Growth Fund are our main sort of business attraction tools. The Vitality Fund, created, I think, maybe 3 or 4 years ago now, is at about $7 million and attracts we use that fund to attract sort of corporate entities by incentivizing them to create jobs, take up vacant space, and create economic impact. And so we've had some real success with that fund. And this past year, we actually diversified that a little bit because, after the pandemic, companies aren't taking up as much space, they have a smaller footprint, or they're hiring for sort of less amount of jobs in a given year. We created the Growth Fund, which is targeted to growth stage companies. So probably think like Series A through C. You don't have like a major corporate headquarters, but you're looking at expanding your presence. And so we deployed about $500,000 this year for growth stage companies. We announced that, I think, a couple weeks ago. We had about 6 or 7 of them who are really cool. And we're hoping to expand that number this year. And so you'll see potentially about $7 million deployed through that mechanism as well.
Thank you, Adam. So what I'm hearing from you is that companies, whether they're small, startup, mid-size, or larger companies, there is a fund that really can meet their needs, that they can kind of tap into.
That's the goal.
And leverage to grow and scale in the city. And so something Chris said earlier about having a competitive advantage to qualify for these funds, by the way, you do have to be DC-based. You have to be a DC-based company to leverage city funds for your company. So Chris, can you tell us a little bit about this competitive advantage that you've experienced being a company in DC that's grown? How has that experience been, and what can you share?
So I'm not a lobbyist, but I've been on the spending side of $25 million in legal regulatory consulting over 25 years. A lot of it comes down to asking the right set of questions, right? Like when you have this sort of premise that I'm working from, or my thesis around fintech is, I call it sort of the financialization of everything, right? You're going to have a lot of these blurred lines, and I suspect unless you're doing something that is an equity, debt, or commodity, or some, it's probably going to be some hybrid of that, right? And especially now with the blockchain, there's all these like gray areas of what things are or what they're not, right? And so I think, one of the things that I tell people is first understand like kind of what you are, or it might even be easier to think about sort of what you're not, right? And in many cases, there may not be any sort of regulatory precedent for those, but you have to have gone through this exercise. And so I think one of the competitive advantages that you have in DC is like you can ask someone, right? Like you might have developed a network. You might have a friend that works on the Hill in a particular office, or one of the agencies, and you could ask them. You know, and literally it could, or any if you don't, you can, you know, go on the website and schedule a meeting. And there's all types of open houses. I mean, even like today, right? If you needed guidance on where to go in terms of DC. So I see that as a competitive advantage where by being here, you know, access just by location, virtue of location is that advantage. And then, you know, depending upon sort of where you are in your journey, there's probably plenty of people that you can reach out to sort of shape sort of that set of questions that you might need to ask if you go into a regulator at some point.
Thank you, Chris. As Chris mentioned, we do have office hours that we announced today, so really do reach out to the Office of Innovation and do reach out to me, and always happy to connect you with the resources and provide that clarity that's needed for your company. This question is for you, Joseph, in regards to the fund that you're supporting DIMPED in launching. You are at the stage where you're identifying investors, correct? Can you just share a little bit about that and what you're looking for in the right partners to kind of deploy these funds to fintechs in the city?
Yeah, of course. I guess to give some context, so our fund of funds model, we are focused on investors and investing at early stage. So, you know, anything from pre-seed all the way to seed stage, and industry-wise, pretty agnostic, but it's fund managers that are committed to investing specifically within DC-based companies. And our deployment period is going to be roughly around 3 to 4 years. And we're very excited. Come December, we'll be announcing our first cohort of fund managers. And the purpose of that was we're expecting and hoping for head into Q1 of FY 2026, you know, we'll be starting to see some of those checks flow out to DC-based companies. So we're really excited for that. You know, we'll be selecting more fund managers in the following year as well. And I think I also want to add, you know, in addition to purely the SSBCI funding, you know, the intention is not just for these companies to get those funds, but it's supposed to also bring attention to those startups that are based out of DC. And maybe, you know, having those fund managers investing in those companies, it's a signal that these companies, you know, have high growth potential. And we're trying to get, you know, investors both within DC, but also, you know, nationally as well, to start investing more into DC. So we're hoping that it galvanizes a little bit more interest within the region.
We love to see that and to hear that. We did receive some of the questions prior to this session, so I'm going to go off of the questions that were submitted in advance. And this is open to the panel, some of the biggest obstacles DC-based fintechs face when scaling.
I think, you know, depending upon sort of what your product is, it might be, you know, one of the challenges of DC is that it's not a state and it has sort of a limited sort of licensing, and there might be, you know, even things like money remittance, like you're required to disclose a little bit more, or I think it's like securities too. It's why Fidelity doesn't have their crypto platform in DC. But there's certain amounts of disclosures, right? And sometimes they can translate or reciprocate in other states. In other times they can't, right? So I think, you know, on one side, like DC is great from a regulatory sort of access and show and tell, but there might be some limited scope. But, you know, but we, on the flip side of that, we also live in a world where there's any number of different partners that can help you scale, that have sort of a national footprint that you could sort of partner with to get you there.
I think too, you know, when we look at what inhibits technologies or companies from scaling generally, you know, DEMPED has looked at this. You know, government, we like to do studies and look at data, and so it really boils down into three things that we see, which is 1, access to capital, 2, access to talent, and then 3, sort of access to space, right? And so I think from DEMPED's perspective, we're looking at, you know, how can we sort of affect access to capital? So we've got a suite of sort of grant programs, equity programs. DISB has, you know, debt and credit-based programs that sort of help expand that access so that you have, you know, the seed funding you need to get your venture off the ground. But we're also, working with groups like Build Within and other workforce development groups to make sure that DC residents are trained and skilled and are competitive in the market so that they're able to get these high-tech jobs that we're hoping are going to be growing here in the city. And then access to physical space. I think when you look at some of the cool work that's being done by the Golden Triangle Bid with Penn West, we've got some sort of centrality happening in Union Market, as well as some other hubs across the city. I think, we're starting to see some of those barriers start to fall down a little bit. And so that's something that DemPed is heavily invested in and will continue to be invested in over the course of the next several years, is making sure that companies have access to the critical resources that are needed for them to get off the ground and then be successful.
I want to just highlight a little bit about what Adam mentioned about the DISB program. So the Department of Insurance, Securities and Banking, my colleague Aaron Fenwick, who's not here right now, oversees a program called the DC BizCap program. And it basically manages several programs to support small businesses in pursuit of capital. The core support includes the SSBCI program, which provides capital to small businesses through commercial loans or investments in participation with lenders and investors. Additionally, DC BizCap launches the Capital Readiness Program, DCCRP, a lot of acronyms, aimed at providing training and curriculum to the district's small businesses in areas of business planning, marketing, social media, contract and procurement, financial reporting, credit education, and business management. And so the goal of the program is to provide district small businesses with the skills needed to be approved for grants, loans, and investments. And so if you wanted to learn more about these types of funds and programs through DISB, feel free again to reach out to my office. But from a regulatory perspective, I think it can be challenging for fintechs to know exactly what license they need. So that can also prove as a challenge, especially from when at the federal level there isn't that clarity that's needed, and fintechs don't really necessarily understand what specific license or regulation they need. And so I just want to emphasize that the Office of Innovation really is open for business, and it's really open to feedback as well, to hear from fintechs about the policies that are working, what's not working. And we are really, when we say we really want your feedback, we want that feedback so that we can adjust laws, regulations that aren't serving our businesses in the district so that you can thrive and grow, because that's our goal really, responsible innovation in the city. And I didn't forget about you, Perry. We really do want to know the connection between workforce and fintech, so the floor is yours.
I'm glad you asked. I think Chris said it best. Being in the same neighborhood and possibly sitting next to your regulators is an incredible competitive advantage, and one that needs to be, that one should institutionalize at your organizations. I'll give you a counterexample of how not to institutionalize this. Sorry to anyone from Capital One that's in the room right now. When I worked there, the process of working with our regulators was mostly waiting for them to have an issue with our work. When a new product or a new technology was used, the credit team would go to the legal team and say, hey, we're thinking about doing this. Legal would say yes. We'd do our analysis, work with the tech team, be ready to launch, go to legal, ask, can we do this? They would say yes. We would release it. Lo and behold, 6 months later, the CFPB has like 94 questions that they need answered about what we're doing, which obviously is not an easy ask to deal with. And so our team's time would be, caught up in answering a plethora of questions that a lot of times our team didn't even really know how to answer. And the clients, the organizations we work with in regulated industries avoid this mostly by upskilling their workforces with the knowledge that you can glean from regulators and other bodies in the area that they're regulated by. So we provide guidance for them on how to incorporate the regulatory knowledge and guidance into their team's work, regardless of if their team is government affairs, or product manager, software engineers. The folks we work with, everyone that works in their company is working from the perspective of regulators are partners, not opponents. Let's think about what they want to see and what they want to know, and make sure that we're meeting that mark in all the work that we do. And I can't think of a single group organization that we've worked with that has had the kinds of problems that my team had at Capital One solely because they take upskilling in the sense of meeting regulatory needs very seriously. So that is the workforce tie-in.
So on the note of meeting regulatory needs very seriously, how can founders engage with regulators early to accelerate approvals? Again, our door is wide open. Regulators, my colleagues, I know a lot of companies are intimidated to approach regulators. They're really nice people. I work with them. I can tell you that. We want to actually engage with companies early on, and we want to hear from the companies about the questions that they have in regards to what they can and cannot do, so that we can provide that clarity and that guidance. So,
you know, and I do this from time to time whenever I have an idea, but I call it sort of the coffee meeting, right? You know, not every regulator will meet you for coffee somewhere, but maybe it's a friend or or to set up a meeting in an office. But even at the idea stage, right? Do some homework so you're prepared and sort of have a set of questions on how to proceed, but make that presentation at that point so you have at least an idea of a go no go on the concept that you have, right? Because the last thing you want to do is, you know, invest a ton of money, build something, and then the regulator's like, well, you probably should have gone down this other path, right? And again, that's a little example of the types of things you can do sooner rather than later.
and we're almost at time. This is a floor open to the panelists. In 60 minutes or 60 seconds, sorry, or less. No, not 60 minutes. Can you please give the audience a takeaway, something that you would want them to remember?
I think I'll just go off the back of the conversation about regulators, and I'll sort of expand it to your government partners writ large, right? Come to us early. Talk to us during your idea stage, during your search for funding, right? I think sometimes regulators or government officials sort of get a bad rap as wanting to sort of put blockages in front of progress, when really I think that there are a lot of innovative and entrepreneurial people who work within the government who are willing to sort of partner with you and figure out what can work and what is going to be best for the city writ large. And look, I mean, there are plenty of things sometimes that we will say we just can't do. We are bound by laws and regulations. But I think at the end of the day, especially with regards to DEMPED or DISB, is we're really interested in figuring out how we can make this environment as best for businesses as possible, and how we can sort of grow the amount of founders, entrepreneurs, and innovators that we have in our ranks. And so come to us early. We want to be your partners.
I would say I have a very, very similar message. The one takeaway that I hope you all have is to think about how are you institutionalizing that advantage of being so close to your regulators? How are you empowering the folks that work at your companies to know what their priorities are, to know what they're looking for and what they're not looking for, and what's going to be possible for the future? Given you're all on the bleeding edge, and I'm sure there are a lot of questions that regulators have internally that are like, hey, there's this new thing, like, what do we even do? You can be, and as founders, you all can be a part of that conversation, but only if you really take that advantage seriously.
I think for me, a big takeaway would be for, especially if you're a founder and a builder, that DC and the DMV as a whole, can really be a big hub for tech innovation. I think DC has always been traditionally seen as maybe more of a service industry, whether you work on the Hill or agencies, lobbyists, or consultants. But I think there's just so much momentum going on here, with programs like ourselves and our partnerships with the city, that there is a lot of attention going into, bringing more tech innovation here. And, I think we at people at K Street, we're super excited. We're very bullish. We think that there's a ton of talent that is really differentiated in the region, and we're really excited to see kind of where that goes. And so if you are building something, really change the perspective, not having to go, to Silicon Valley or to New York, but this can really be a place that you can have roots and have support from a broader community. And I think we'd also want to reach out, if you are a fund manager that's raising a fund or an early stage startup, we'd love to connect and, try to be as helpful as we can as well.
know the legal term facts and circumstances, and understand that about your idea, your venture.
Aside from scheduling one-on-one with me and the Office of Innovation, I will say check out our there's a website called Obviously DC, because obviously DC is the place that you want to go to set up your business. But on this website, it lists grants that are open, and it's constantly updated, so you have an idea of at least what the city is offering from that perspective. So round of applause to our panelists and Kevin's over. Thank you all.
Thank you.
AI and fintech building successful pilots that scale. Part of the reason why we ended up choosing that topic is because I'm seeing right now tons of pilots that end up showing up either in healthcare, fintech, a bunch of these regulated industries that just fall on their faces. So show of hands real quick. How many people out there are founders? A little bit closer, better? All right, so how many of you have vibe coded your current platform? All right, yeah, just kick it out there. So something that I've seen recently, which is kind of disturbing, is that people are vibe coding platforms and they're handing them to people and they don't understand the code that's running underneath the systems. And you know who some of those people actually are? Me. This is something that's very, very dangerous, and this is something that as investors, advisors, entrepreneurs, anybody out there should end up paying a lot of attention to. And so I've actually started to spend a little bit more time focused on process. And this is something that kind of kills me, because at the beginning of my career, I was the most anti-process cowboy coding person. I started off in .coms early on in the DC area, experienced the .com bust, and then ended up going over to DARPA, ARDA, that kind of Beltway Bandit stuff, focused on security inside of the government. Got burned out by that, went back to school, is Chris still in here, Duffus? Yes. Met Chris, he pulled up in a Maserati, and I thought, man, this guy is who I want to be when I grow up. And so I found out about fintech through his lens. But basically, I was the biggest cowboy coder you'd ever meet in your life. But I knew every single bit and byte because I was a security person. I wasn't a compliance person, right? And so I used to always object to being grouped in as security and compliance. So next thing I know, startups happen. I had a bunch of booms and busts. Then, one of the businesses that I helped to co-found, Higher Logic, in the region, we ended up growing that. We focused on associations and nonprofits because it was a small vertical. People didn't really care about compliance programs inside of the association nonprofit space, and so we were able to stay away from that for years. We grew that for about 8 years before we ended up bringing on a capital partner, and then we subsequently acquired a ton of different businesses. So, during that process, we ended up going from, focus on selling to people who didn't care about security and compliance to all of a sudden starting to sell to the Fortune 500, having Microsoft as customers, Broadcom, Verizon, very, very large organizations who cared a lot about it. And it was very difficult to retrofit, and very expensive in each one of the product lines, security program. And so after feeling that deep pain, after I took a couple years off because I was trying to figure out what I was going to do with the rest of my life, because the business had grown to a point where I felt like I was walking around and I had a teenage kid that had just gone to college, and I was showing up at the football games, and everyone in the business was Dad, leave me, come on, give me a little bit of space. So took off for about 3 or 4 years, and during that process, one of the businesses that I incubated was with some really young smart guys out of Yale, and it was actually a reg tech business, because I was thinking that one of the main reasons why crypto is not adopted by mainstream, and it's very hard to sell crypto components into other organizations, is because of the lack of insight and trust. And so if there was, who's familiar with Secure Frame and Drata and some of those platforms? So there's like, systems and protocols that you have to, adhere to, like, SOC and ISO and those kind of things. And those are very expensive and cumbersome to collect information about and be able to comply with. But all of a sudden, these companies ended up showing up on the field that allowed you to, near real time, validate that you were in compliance with those frameworks. And so I was thinking, well, heck, it would be absolutely awesome if there was a piece of technology that ended up helping you stay in compliance with, like, security and protocols and best practices. And so ended up building out the process and the systems and the team. And then all of a sudden, the crypto bust happened. And so I got super burned out by crypto. I don't think that that's a horrible idea. I don't think it's a horrible idea at all, because I think there's still a massive gap. And so anybody that's in the crypto or reg tech space, please think about whether or not you would want to. And I could tell you some of the lessons learned and intro you to some of the people that I had spoken with, but left that world because I lost an enormous amount of money related to the Three Arrows Capital bankruptcy and UST, and lost a ton of Bitcoin and a number of different things. And all of that had to do with lack of transparency. And so that's one of the things I think is really important about compliance frameworks, is that one of the things that they do is help you to be transparent. And I think that that's something that's really important. And so related to building businesses, so now that I've gone back and I've been investing and advising for a while, any of the businesses that I've been helping out over the last couple of years, the very first thing that I do is I get them to focus from the beginning on understanding the market that they're selling into and the requirements of that market related to compliance programs. Because what I found out of the 7 businesses that we had to retrofit compliance programs onto, it was incredibly costly, and it slowed those businesses' innovation down to nearly nothing. Because now all of a sudden you had to put people into a process. And what I found is that the minute that you put people into a process, everything slows to a halt because everyone wants to do meetings. And especially if there's anything that's risk related, and then people are sitting in a meeting, they're like, okay, let's follow up with some people. And so now all of a sudden your ability to make decisions goes to nearly zero. And so I think it's really important when anybody's thinking about designing a new business or investing in a business to look at the systems and processes that they've got around innovation and ensure that those organizations have built into their software development lifecycle a way to be able to adhere to security and compliance programs. So, with that vibe coded platform that you've built out, are you a technologist by background? And so that system that you've built, how do you end up ensuring that you didn't end up vibe coding something that's got a security vulnerability or a flaw, or completely ended up causing a regression? Okay. So something that I've been doing right now with one of our businesses, we've been stopping the traditional software development lifecycle. What we found is that it took about from a product manager speaking with a prospect or a customer to then being able to get the prototype back in front of them was about 9 weeks to be able to validate whether or not the thing that the customer had asked about, asked us to create, or the prospect had asked us to create. 9 weeks is a really long time. We found with some of the vibe coding platforms, that goes from 9 weeks to 9 minutes. And so from a value creation perspective, we were like, oh my God, we need to enable that. But there's a massive amount of risk. There's an absolutely massive amount of risk in creating something and then allowing a person who's creating something to just take it and publish it and push it out. And so how do you capture and handle that? Well, one of the ways that you end up doing it is you end up building, security and compliance into your software development lifecycle. And so this is something that that we've been spending a lot of time on. And so if anybody's got any questions or anything about that, that's something that I'm pretty passionate about. It's something that I work with a number of different private equity firms and take a look at how they're valuing businesses right now. And one of the key things that I've been hearing from everybody is that the businesses that are getting valued the highest right now are the ones that not traditionally. Anybody know what rule of 40 is? So it's basically take the profitability of your organization and you add to that the growth in percentage, and then you subtract from that churn. And that was the key way that all of these organizations used to traditionally, private equity, so post-venture, used to value businesses. Now, one of the key ways that they're valuing businesses is the rate at which they can kick out new products. And so if you can build into your organization a way to, in a compliant fashion, create new products, what we're finding is our traditional life cycle was about 18 months. So it used to take us about 18 months from the time at which we'd come up with a new product concept, and it would take a massive number of team members, to now it's taking us about a quarter. And so if you think about the difference in the breadth of the business, over 3 years that you're gonna have invested in or built, if you end up focusing on their ability to deliver compliant and secure solutions, you're gonna have a completely different outcome. A completely different outcome. And so it's really important to think about how to create a sustained, scalable, compliant process. And so that's something that that I think is really cool that we're focused on right now. Anybody deep inside of RegTech? So anyone familiar with the concept of agents and subagents? So this is where I think that coming up with a compliant process before you start building can really shine. So if you think about the things that traditionally were part of the software development lifecycle, one of them is security. Another one is checks and balances. There's all sorts of different components. There's testing. Testing normally ends up getting completely left out of most organizations early stage plans. You can now using Claude Code or Codex or one of a million different platforms, just have a set of post-commit criteria that just go in and then analyze the current checked-in code and look for security vulnerabilities. There's also packages from GitHub, from Sneak, from a number of different organizations that you can do that you can utilize that'll do static analysis and dynamic analysis of your code base. So if you end up building those things in from the very beginning, and then you end up choosing a partner like a SecureFrame, Adrata, Avanta, and you layer that stuff in, instead of costing what was probably about 120 to 150K in direct compliant costs, with also wasted overhead time from staff on each one of the product lines we had, dropped it down to about 15 to 20K a year by using some of these continuous control monitoring platforms in conjunction with good tooling related to the things that allow us to check boxes in these compliance programs. And so there's a health tech business or a healthcare business that I'm part of advising and helping to grow, and they've absolutely smashed their competition recently. They kicked Microsoft out of their largest emergency department customer. They kicked 2 other multi-billion-dollar organizations out, and it was just 3 guys that had founded a business that was ambient listening technology. So if anybody's in the healthcare space, just AI scribes, they were able to take what would have traditionally been an 18-month implementation process and bring it down to a week because of the capabilities that they've got inside of their software development process to very quickly kick out features in a compliant fashion. They're ISO, SOC 2, and HIPAA compliant. And because they built that into the ethos of their organization, and they made it so that they had processes that were in place before they started to build their platform, their pilots have all absolutely trounced their competition because they're highly agile, they're AI first, and they can end up scaling their configurations because they're prompt oriented, because they got prompt oriented customization capabilities that are edge side to the implementation team. Fascinating to see 3-person organizations just trounce Microsoft from a timeline and a cost perspective, which is something that everybody in here should be thinking about when they're either investing or building a business. Is like, what are your competitive advantages? One of them is like your cost and your agility, and like nothing's going to slow you down like retrofitting a compliance program onto an existing process that you've got. And this is something that's like, absolutely burned a lot of organizations I've seen, is that like they'll go in, start a pilot, they'll have overwhelming value, but then someone from security and compliance at the customer side of the house will come in and take a look at like the compliance program or the lack thereof of the controls that you have in place, and then go, we can't use these people. And so you'll have wasted a massive amount of money on a pilot, and then you get kicked out, which sucks. Which really sucks. Anyways, I ripped through a couple minutes. So I had a set of slides, and I was going to end up like going through a structured set of slides, but instead you got chained to thought.
Awesome. Thanks, Carter. Appreciate it. Round of applause. Thanks for taking time.
Okay, hello everybody. Today we're going to demo Split. Split is a payment rewards platform. It's designed to bring down a business's payment processing fees.
Okay. So the problem that Split is trying to solve is that card processing fees are killing small businesses. Brick and mortar retail stores lose over 3.5% of their revenue to card processing fees, and that's thousands of dollars per month just to accept payments.
So we built a solution. The solution is actually very, very simple. We allow a business to accept in-person ACH payments with the same sort of ease and convenience that the customer would expect when paying with Apple Pay or with a card. The infrastructure is pretty simple. It's an app, a customer-facing app, and a business-facing app, and then we have a NFC payment reader that we've made with epoxy and an NFC tag. This costs less than $1. And this is us. This is Mauricio. My name is Taylor. We're really excited to be here. And now we're going to give you a quick demo of our product. This is going to be a screen recording. This is the customer-facing app, and this will be really fast. So you can see, you tap on the icon. This is going to be your home screen. If you can pause it. So we've already loaded a bank account. That's where the card is created. At the top, you see a token balance. We have a reward system built into this to give users a reason to want to use this versus their credit card, which also gives them rewards. And then if you tap on that card, and you can keep playing it, if you tap on this card, you'll see this pops up. This is where you would enter in your bank account. You just sign in to the way you would in your banking app. And almost every bank is supported in this. This is through Stripe. This is the reward screen. This is where you'll see your token balance at the top. And then this gives you the breakdown of how the rewards work. You can pause it again. It's really simple. Every dollar you spend, you get a token. Every business creates rewards, and then they just take that price, they times it by 10. So your tokens come out to about a 10-cent value, which is 10%. The businesses can do this because they set limits on how many rewards they give away each month, so they know their liability up front, even though it's that 10% thing. And then you can go again. And then you're going to see, so if you can pause it again. This is a business, and these are the rewards that the business created and listed. That's the cost of the tokens. And then if you click on one of the rewards, you go to this screen where you would redeem it. And if you had enough tokens at the bottom there, you could push that button, and you would tap this NFC reader, and it would process your reward. And then I think lastly, we're going to go to transactions, which basically just shows you it's a record of all the transactions you made in the app. And then we email you a copy of this. We actually email it twice because I don't know if you guys know about ACH, but it's a delay. So we email it to you when you make the payment, and it gives you all the information. And then we email it to you when the payment has completed several days later. So now that's pretty much how the customer-facing app works. So now we're just going to run a payment. We're going to show you how fast it is. I wanted to do this in person so you could see us tap the NFC device, but if you can go back to the beginning. So this is the home screen. To make a payment, we've already have our bank account loaded. You're going to slide that arrow where it says slide to make a payment. And now there's a biometric ID or passcode, and then this pops up, and then this is the point at which you would tap the NFC reader. You can pause it. And so this screen, the user then, the business will tell the user how much they owe them, and then the user will type that in. We've gone back and forth with this. We had different variations, and one variation, the business entered it, but there's too much, it's too slow for the business to have to enter it in. So we're trying it now where the user does it, and we're gonna see the rate at which users don't do this very well to make a final decision. And then after you enter the amount, you have the opportunity to enter a tip, and you hit that pay button. If you have enough money in your bank account, the payment will start and it'll be processed. You'll get a confirmation screen, and then in the business app, it shows up with your name and the amount that you paid. And that's it. It's meant to be just like Apple Pay. We're trying to make it as close to that as we can. That's it. Thank you, everybody.
Thanks, guys. Fantastic. Thank you so much. All right, next we have scripted AI.
Let's pull it up.
There you go. You want to do stand at the podium?
I think I'm going to stand here, guys, and just talk to you. So, okay, great. Hey, I'm Tim Cotton. I am the co-founder, technical founder of Scripted, and we are building something new. We are building a platform for doing micro-lending to AI agents. And we've essentially invented a new AI native yield asset that I would like to talk with all of you wonderful regulators about because it's brand new. We are backed by Andreessen Horowitz's CSX and Palm Tree crew. We started this journey last year in October, kind of in London at their big accelerator. We had an amazing time working with their primary research group. So what I'm going to tell you about, I'm going to try to load your context windows in your heads a little bit here. Thank you for, someone laughed about that, thank you. When you think about AI agents, right now, what you're hearing in news articles, what you're hearing like on shows and stuff is very skeuomorphic, very human-centric, very, let's make a customer service agent, let's make a travel agent that books your hotels for you, right? And I want you to open yourself up to this idea that there are non-human equivalent valuable AIs. And I want you to think not of AIs as giant human level thinking. I want you to go back maybe a decade, think about like smaller micro AIs, and I want you to think about them as what happens when we give them the superpowers of today's deep learning. Well, what you can do is you can solve the boardroom problem. And this is why I love what Connor Sibley was talking about. We already, thanks to vibe coding and other platforms, are able to compress a software development lifecycle or product development from 9 weeks to 9 days. That's a phenomenal return on investment for anyone, right? What I want to give you is the ability to autonomously compress that to 9 hours and eventually 9 minutes. What I want to give you is a platform where any business or developer or an intelligent enough AI agent can register a microservice. Instead of trying to solve the biggest problems, solve tiny problems. Decentralize Amazon Web Services, for instance. Turn every single facet of computation into something valuable. Not as granularly as Ethereum with doing it by opcodes, but do it by business logic. Take all those lovely margin improvement initiatives that you all have at your boardroom level and say, how do we arbitrage this? How do we turn this into something valuable? So what we're going to do is I'm going to tell you about 3 primitives that we've invented for this network. The first one is microservices. I've said the word multiple times. What I mean is I want you to think of something like text to video. Right now you can go to Sora 2, you can generate a beautiful video, and how does it work under the hood? Well, it's not just one model, it's not just one AI, it's an entire workflow of different services that are working together to understand your intent, to plan out the scenes, to fetch the audio. Well, all of us can do that, and I've built you a network so that you can actually make money off of it. For instance, you could build a slightly better microservice and attach it to the audio generator part, right? But instead of me managing everything, I simply attach a micro ledger to every one of those microservices, a P&L for every component. And instead of me having one massive AI agent that tries to watch this entire network, which will not work, I just attach each of them a little tiny micro agent. Its only job is to like watch the P&L, look at the code, and spend a little bit of compute saying, what could I do better? Now, what's really fun about this is that once you register a service like that, it's just a bunch of code, you could watch its P&L, or it's just watching its P&L. And it says, I have an opportunity in front of me. I want to execute on it. Cool. There is a new standard in Ethereum as of this week. This is the opportunity capture. This is the velocity, called the Trustless Agent Registry. We can now upload all of that data, and we can depend on it. Then, once the performance analysis is done, the agent just said, hey, I don't actually have an eval benchmark, so I can't improve myself. No problem. The agent is allowed to take out a microloan. We call it a margin improvement note. It's a note based on its expected future profits on the margin that it's going to improve. We tokenize it. We turn it into an actual Solidity contract, and it's out there on the base network. I would like to thank Sebastian at Signature Ventures for being the first microloaner for that. And then performance bidding. We partnered with Mayur at Vistara Labs. He actually created an agent that created the benchmarking for us, got paid by the microloan, and boom, suddenly I think it took less than an hour, this agent was able to improve its own service. And as you know, these are tokenized assets, these new MINs. That means that you can trade them. You could bundle them. I'm Tim at Scripted. Please ask me questions after.
Thank you so much, Tim. Appreciate it. That's great. Thank you so much, Tim. All right, we have smart funds. Coming down. There we go. All right, take it away.
All right, I'm JJ. I'm one of the founders of Smart Funds. We're building the institutional tokenization platform to bring U.S. private markets on chain. So if you haven't heard yet about tokenization or understand why it's important, you will soon. And so it turns out that actually putting securities, particularly private securities, on a blockchain is a really complicated problem. And we've solved it in a very interesting and unique way, which is we've built a natively tokenized SPV as the base layer of our tokenization platform. Above the SPV, we are an SEC registered transfer agent. We have access to broker-dealer and ATS licenses through a partner, which is what gives us our full stack approach, which means that we can issue private securities on a blockchain and also allow them to trade on a blockchain in a permissioned securities compliant environment. So what we're launching actually tomorrow on Product Hunt is our roll-up and syndicates SPV product. And we'll give you a quick demo of that right now just so you can see what that looks like. So anyway, this is a demo of our SPV product. This is called Super Hot Round. It's a 500K deal, 42.5K already closed. No additional commitments. It's currently open to capital. On the right, you can see the capital contribution history chart. As you scroll down, everything you'd expect to see in an SPV, you have your data room for your diligence. You can see this deal is being run by Babe Ruth. It's a 0 and 10 fee structure. You can see on the cap table, there's currently 3 people, and we're going to add a 4th as part of this demo, so you can see what the onboarding process looks like. So here on contributions, these are closed investments, and the important thing here is this column in the middle that says transfer method. And what you see is that some people are closing using USDC, and others are closing using traditional banking, so you don't need any crypto knowledge or infrastructure in order to use this. The transaction is tokenized either way. So we're going to go ahead and invite an investor now. And again, everything you'd need to be able to run an angel syndicate or a seed stage product. You can give minimum and maximum investment amounts. Do they get any shared carry if they're part of your network? And then you just click send invite. And boom, now we see that there's a 4th investor invited. We know that this is Mick Jagger because Mick Jagger is already a KYC'd investor. We know that Mick Jagger is an accredited investor because he already has that credential, but it says that he hasn't signed his documents yet. Obviously, we just invited him. So let's go over to his email. This is Mick Jagger's email. And you can see that there's an email that arrived 0 minutes ago. Babe Ruth has invited you to invest in this deal. So he clicks on view deal. And so you can see the deal dashboard, and again, it confirms that he's an invited investor. That's for compliance with 506B marketing rules. So he does his diligence. He says, okay, I want to invest in this deal. So he clicks accept invite. It then confirms that you're KYC'd and accredited. I obviously invited an account that already had those credentials. And then we click next. It now spins up your deal documents in real time. We use electronic signatures for compliance. So we're going to go ahead and sign with the name we KYC'd with, which is Mick Jagger. And we're going to go ahead and click Sign Documents. So those documents will show up in your investor reporting tab, but let's go ahead and download them here so we can just confirm what we just signed. So we go ahead and download them and open them up. And so the first thing you're going to see is the metadata required for compliance with electronic signatures. So you can see that this is for Super Hot Round, and the signer is Mick Jagger, and you have a date and an email address and an IP address. So this is fully compliant as an electronic signature. And now if we search elsewhere in the documents that we just signed for the next place that we might find Mick Jagger's name, the next place is the signature on the subscription agreement. So as part of this process, you've signed up to all the requisite offering documents for a compliant Reg D offering. And now we click next and go to the closing process. And again, in this, you have the option to use stable coins or traditional banking for those people who are not comfortable with stable coins yet, but we're going to go ahead and close using stable coins because it's always easier. And we're going to go ahead and invest $15,000 into this deal because that's a unique number on the cap table. That'll be our fourth entry. We go ahead and execute the transaction. It says capital has now been sent. Boom, it now changes. It knows that Mick Jagger's documents are signed. And as we go down to the contributions tab, you'll see a fourth entry show up and it says pending. And now it says completed. So we'll go ahead and click through. So everything you've seen so far looks like regular old fintech until now, because now we're clicking through to the tokenized transaction receipt. And you can actually see this is the tokenized cap table where there's now a fourth person on the cap table with 15,000 shares. And so what this is, these are not cryptocurrencies. These are compliant Reg D securities that are natively on the blockchain. From there, we'll be launching our tightly integrated on-chain secondary private equity exchange coming after that. So anyone in the private markets, whether you're an investor, whether you have late-stage holdings that want access to liquidity, we have a whole bunch of different transaction types. Please come up and ask questions. I'm happy to tell you more about it.
Guys, how are you? Awesome. I heard folks talk about SSBCI. How many of you know what SSBCI is? One person. State Small Business Credit Initiative, part of the Department of Treasury. Back in 2010, they created the Small Business Jobs Act that allocated funds to every state and territory. As Kevin is doing that, I know. So anyhow, long story short, I was part of that team. I was one of the portfolio managers, 24 states, territories, 2011 to 2017, program sunset in 2017, and I happened to take a chance on myself, understanding there was friction within the ecosystem. Ecosystem, I'm referring to public. We all know governments can be very inefficient, right? We also know that private industry is always trying to identify that next win, especially if you're a VC, right? And then the small business or the founder. My goodness, I am one. So I can tell you I've been on both sides, and it's extremely, extremely fun at times, but it can also be extremely challenging. So in 2020, we convened my former portfolio of economic development practitioners, and we started talking about what can we do in light of COVID to support small businesses and founders. And what came out of it was Dave and team go out there and design a flexible fintech platform that can fill the gap where public and private isn't currently participating. What you're seeing is the capital access application tool, and this is going to be a demo specifically targeting SSBCI portfolios. So what you are seeing here is the dashboard for the Economic Development Portal. Our platform has 4 portals, including public, which could be state or private, or state or federal. We also have private, which includes financial institutions, CDFIs, MDIs, credit unions, and then on the equity side, venture capital, and then of course the small business. So the platform integrates seamlessly, leveraging AI and blockchain. So what I'm going to show you here is the Economic Development Portal that a state would actually use. So here you can see, we'll go to State Small Business Credit Initiative. We can scroll down. This makes the state smarter. You can see everything that's in their portfolio, from credit programs, business demographics, transactions, equity programs, if they actually have them. Going over to reporting, we're going to go directly to Treasury. We're going to go to SSBCI. So here, you can see we have already pre-populated the Treasury reporting quarterly report that shows obligated funds. It also shows committed funds as well. We can also go here to the annual report. Treasury requires every participating jurisdiction to submit reports quarterly and also annually as well. Moving on, we can go to transactions. We can select SSBCI. Here we can see specific transactions, 90 days, 12 months, 30 days. SETI. And SSBCI 2.0, every state must have a SETI target and meet that SETI target so that they can draw down all of their funds. Our CAT tool has the ability to actually identify if a participating jurisdiction is meeting that target. Moving over to performance. Here, we have program performance for all programs and platforms. So here you can see the money received was 128 million, and we are able to track if it's been funded, unfunded, etc. I'm going to move us over to applications. Here, the Economic Development Office can actually identify where a transaction is in real time. You can go to details. You can see everything, all the loan information. That should actually work. Documents, OCR, compliance based on Treasury's regs and rules, the status, the blockchain. Finally, I'm going to go to funds. You can see our VCs. And systems. So here, you can see we have the ability to add payment options. Also, every state receives 3 tranches, so our platform allows you to actually track every single tranche. And here we go. You can actually see how each portfolio and program is allocated. And so thank you very much. If you have any questions, please see me. I'm happy to announce on November 1st, we will be deploying our platform to the 4th largest economy in this nation. Have a great day, guys.
Amazing.
Thank you.
Thank you so much. Last but not least, Paul Briner with Zcash is our closing keynote.
Thank you, Kevin. So when Kevin kicked off that last session, he was saying that it was the most dangerous session of the day. I thought he was talking about me, and I thought, dang, how did he know what I'm going to say? I mean, it's like, did he realize that I was going to get up here and say some things that I think are going to, catch your attention at least? Well, I'll do my best. Try not to be too dangerous. So I'm Paul Brigner. I'm the Vice President of Strategic Alliances at Electric Coin Company, and I teach at Georgetown, adjunct faculty there for FinTech, and I run a monthly breakfast meeting here in DC called PGP for Crypto, or Pretty Good Policy for Crypto, basically for the crypto policy community to get together on a regular basis to figure out how we can move forward with good policy for this industry. I also do another event that's on Thursday of this week. I'm going to get that out of the way too. If you're into privacy, which I'm going to talk about a lot here, there's the DC Privacy Summit on Thursday. So check it out, dcprivacysummit.org. Well, I want to thank Kevin and the DC Tech and Venture Coalition, also the DISB, including the Commissioner and Tamara of the Office of Innovation. It's just such a privilege to be here, and I see so many friends in the audience. And just as we started today, where Dante got up here, and boy, he's so eloquent. Man, I just wish I would be half as eloquent as him, but I won't hit that standard, I know. But he had a mandate from Kevin to cover basically the landscape, very broad, and I do too. Ultimately, I'm going to get to the question of who will win the fight for the future of finance. regulators, innovators, AI, or global markets. And I've got really big news for you today. I think it's going to surprise you a little bit. But before I share that news, I want to share some profound facts that will provide a foundation for this talk. And they're not really pretty facts, just to be very candid with you. As of now, the federal debt held by the public is estimated to be about 98 to 100% of GDP. Possibly now or very soon, U.S. debt interest costs are projected to exceed defense spending starting around now or next year. I was very fortunate earlier, I guess it was last week now, to attend a very exclusive meeting at the Milken Institute where all the representatives who are here for the IMF meetings were in attendance to hear the IMF managing director give an overview of the global economy and give her outlook. And she shared a couple of key stats. One of them is global public debt will exceed 100% of GDP by 2029. So what does all of this mean? It means the ability of governments to use fiscal monetary policy to adapt is shrinking dramatically. The debt service burdens will consume more public revenues, therefore less social programs, other services provided by governments. Investor risk spreads and may rise. The debt crisis, there's a debt crisis in vulnerable countries, and policy trade-offs become tougher. Basically, it limits the global financial system's ability to adapt. And back to the IMF Managing Director's remarks, the other stat she shared is that gold now exceeds 1/5 of the world reserves. That's a pretty big deal. And if you saw the chart that she showed, it was like that. I mean, up and to the right, it's usually a good thing. This is not a good thing. Trust me. What does that mean? Central banks are more inclined to hold gold as a hedge against currency risk, counterparty risk, etc. If gold is becoming a larger share, it implies less dominance for foreign exchange holdings, currencies. Currencies are becoming weaker relative to hard assets. And there's just more volatility sensitivity. So you have to realize that gold does not provide yield, right? You're not making money on gold. So when central banks increase the gold share of their reserves, they're not seeking income, they're seeking safety and diversification. Basically, they're doing what all good investors should do, is flying and moving as fast as you can to hard assets in this very uncertain environment. So I'm sorry to be the messenger of all of that information. It's all the truth. Ask ChatGPT. At best, in my opinion, the global financial system faces a prolonged period of fiscal tightening, elevated inflation risk, and shifting confidence in assets and currencies. More likely, in my opinion, we'll see significant pressure on government budgets, leading to cuts in critical services, and the gradual debasement of currencies. And that is me being polite for a mixed and sophisticated audience like you. I think it's much worse than that, honestly. Moving on from that rather bleak fiscal picture, I want to share where a couple of things that I think, and this is like shifting now from like really bad stuff to good stuff, okay? So there's good things coming. To shift to what I believe is a very important thing to understand about blockchain and cryptocurrency. And as I mentioned, I teach at Georgetown. And remarkably, when I have my first class for every semester, one of the questions is, please tell me what you think is the fundamental capability that's been unlocked by Bitcoin and other native cryptocurrencies. And they almost never get it. In fact, nobody has. I would ask the question here, but we don't have time. I'll give you the answer. They introduced digital bearer instruments. Okay? That's it. We're not going to talk about hash functions. We're not going to talk about consensus. We're not going to talk about all the things. Byzantine fault tolerance. Okay? None of that. It's very simple. Digital bearer instruments. And guess what? That is a very truly profound development. It's a capability that has never existed before in human history. So you're going to have to let that sit in for a while if you haven't thought about it from that perspective. But I'm going to just do a little jump here because I don't have time to lay the full foundation for this. In my opinion, all of this background lays the foundation for what could eventually become, and I'm talking about a scenario for future generations, a gradual separation of money and state. That's a big deal. I mean, it's very hard to wrap your head around how big of a deal that is. But I am certain that is the path we're on. I am certain it's an inevitability. And that's why you need to take blockchain and cryptocurrency so seriously. And it may not be for you. It'll be for, again, future generations. Okay, you want the big news? All right. That wasn't the big news, believe it or not. When you're really deep in crypto, you find out that the crypto community celebrates seasons. Well, I don't know if it's celebrating. It's not always a celebration, I guess more a recognition. We've had Bitcoin season. We've had altcoin season. We've had DeFi season. We've had NFT season, meme coin season, layer 1 season, layer 2 season, altcoin season, regulatory or bear market season. Guess what season it is? And this was just declared this week. It's privacy season. And it's a big deal. And it just so happens that what I am doing and the part of the community I'm in and the company that I work for, we're kind of at the epicenter of this. So it's kind of really good timing for me to be able to share this with you and tell you a little bit about it, because I think it's going to be something you're going to be really happy you know. And by the way, NFA DYOR, right? It's not financial advice. Do your own research, hire a professional, all that stuff that I don't have to tell you. But I am going to talk about where I think things are headed, because I have to. I just can't stop myself. All right. So as I mentioned in the beginning, I work for Electric Coin Company. We're the developers and creators of a cryptocurrency called Zcash. And I guess I want to tell you the whole story about it, because as my mandate was given to me, I needed to tell you about market trust, policy clarity, DeFi, and AI, and how that all fits into this picture. So I'm going to tell you about all those things and how it fits into the story of Zcash and how we arrived at privacy season in crypto. So you all know Bitcoin was created in 2008. Zcash was created in 2016. And for most of that history, from 2016 to today, Zcash has been considered mostly a science project in crypto. It has been some of the most OG, original crypto cypherpunk people are part of the Zcash community, but also some of the most academic and scientific ones and the cryptographers, world-class cryptographers, are part of the community as well. And it hasn't been in the headlines. It hasn't been price pumping. It's not something that probably most of you have even heard of, candidly. Well, that will change now. So why is it called Zcash? I think you need to know this story. I'll try to go through this quick, 9 more minutes. Zcash refers to zero-knowledge proof technology, and it is a huge cryptographic development for being able to prove something without revealing all the facts around that. So let's just put it into a context of having a cryptographic driver's license. Right now, when you share your driver's license, you share a bunch of data about who you are, where you live, things that are not relevant to how old are you so that you can buy liquor at the grocery store, right? Well, a cryptographic proof can, if you exchange it digitally, can prove to that third party that, yes, I'm over 21 without revealing any of that information, all right? That's kind of the key thing here. And what's really interesting is that if you apply that to Bitcoin, you're able to have, and this is based on a lot of scientific and academic work, what is essentially a fully encrypted blockchain. So there have been a lot of people up here today telling you that blockchains are fully transparent, and for the most part, that's a good thing, because governments need to be able to see what happens on blockchains so that they can stop bad actors. Well, I have the exact opposite view, and it's complicated. I probably don't have time to give you the full story of why I believe that, but I'll give you just some pointers. When government sees all that you're doing, the whole world sees all that you're doing on the blockchain. You guys are probably well familiar with data brokers and credit bureaus and those individuals, those companies that collect massive amounts of data on you. If you're using public blockchains that are transparent, you can guarantee that your name, even though you never put your name in that blockchain, is going to be associated with anything you ever have done on any of those transparent blockchains. If you're a company, anything you've ever done is going to be shared with all of your competitors. How much, when, to whom? Let me tell you, if it's not obvious, that is not workable for a financial system, okay? So as much as you hear people get up here and tell you about their excitement about stablecoins and the Genius Act and the Clarity Act and all the things that are happening that are so amazing that blockchain is going to fix all this stuff, until privacy is fixed, it is fixing nothing. I promise you that. So back to zero knowledge proof technology. Quick history lesson here. Zero knowledge proof technology was discovered. All cryptography is always there. I guess it's just discovered, right? So it was discovered in 1985 in academia. In 2013, there was a paper called Zero Coin. In 2014, there was another paper called Zero Cash. There were 7 scientists that wrote these papers from the Israel Institute of Technology, UC Berkeley, Johns Hopkins, Tel Aviv University, and MIT, some of the best cryptographers in the world. And that they eventually came together after 2013 to 2016 to form Zcash. Now, today, here we are, 2016 to today. Why do I say that we are at this point of privacy season? Well, it does involve DeFi, let's say, first of all, right? So for the most part, as I had said before, Zcash was a science project. Well, we got some new leadership about a couple of years ago, year and a half ago, that was market-focused and user-focused. We developed a cryptocurrency wallet. It's called Zashi, Z-A-S-H-I, that allows you to hold your Zcash, send your Zcash. But not until just about a week and a half or 2 weeks ago did it allow you to move your Zcash with great ease between Zcash and any other cryptocurrency. And that has proved to be a game changer that none of us realized. Because what people really want, what a lot of, especially if you think about the very influential individuals in cryptocurrency that are very active on Twitter, they want to be able to hold their wealth privately, and they want to be able to move out to go to some other blockchain and do some transaction without anyone knowing what they're doing, because, and you say, well, why would you want that? It sounds a little fishy. Well, it's not because of anything other than what I described earlier, in that the transparent system doesn't work. But more importantly, it's about freedom. It is, if you think about this a little bit more, another one of these really profound things that I think people don't really spend enough time on is if you don't have the ability to spend privately, all of your civil rights and all of your freedoms are at risk. You really have to let that set in. I don't have enough time to tell you all the reasons why, but you got to trust me. on this. And do your own research here, for sure. You've got to be able to spend privately to have freedom. So that's why so many people like it. And that was the unlock. That was just what really made it happen. But there's a whole series of factors that I could tell you about that go to trust, because we were talking about market trust is one of the topics I wanted to cover, right? Why do people trust Zcash? Well, it turns out Zcash is one of the most decentralized and widely distributed cryptocurrencies of all, rivaling even Bitcoin. I love Bitcoin, by the way. But let's talk about concentration of holdings. Bitcoin's top 2% of addresses hold 90% of the supply. That's a lot, okay? How many are there out? 21 million is the max, we all know that. I think that around 20 million have already been mined that are already in existence. It's probably more than that actually, but it's still, there's a long emissions curve. It's gonna take a while to get to 21 million. So that's pretty high concentration. A little bit of a concern. Maybe they're all in Satoshi's wallet and he's dead, I don't know. But for Zcash, we actually had what's called a fair launch. And again, I don't have time to describe this to you, but if you're interested in crypto, you should know what a fair launch is. There's a very few cryptocurrencies that have had a fair launch. Zcash, Bitcoin, I think Dogecoin, maybe a couple others, but that's about it, all right? It's really important. And then this long period of like the prices being at like rock bottom levels. Over the course of the history of Zcash, the price has been roughly $30, maybe 50. And people have just been holding it out of pure passion because they just believe in this project so much. Well, part of what happened with this release and this new capability, it went from 30 to almost 400 in a period of like 2 days. And there's, I mean, right now, given global things that are happening, you know, with trade and so forth, like everything is a little bit distressed and depressed. But this train is not stopping. I can promise you that. This is a season, a privacy season that has come of age, and it is so needed because this is the tech that we need. And it doesn't have to be Zcash, by the way. But this zero-knowledge proof tech is what we have to use this new technology for the benefit of humanity. So we call Zcash unstoppable private money. We are building a system that is separate and aside from the financial system. That does not mean we're anarchists, by the way. I also do all those events that I told you about with PGP, Pretty Good Policy for Crypto, and I do the DC Privacy Summit, which is this Thursday again. Feel free to come. So I have not lost hope. I am working with the best innovators in the world, who are going to be there on Thursday, by the way, to find solutions to these problems, to maybe give regulators and policymakers options to fix this system that is breaking down fast. If that works, I'll be thrilled. If it doesn't, I'll have Zcash. Thank you all.